just makes sense for First Republic to be a part of a large money center bank like JPMorgan.
The fact remains that there is still a fair amount of stress in the banking system.
There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem.
It's hard to divorce the Fed's actions from what's happening in the banking sector.
The sad thing is the Fed is going to now regulate these smaller, medium-sized banks when it was Fed policy itself that caused this crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa back with us tomorrow for the Fed decision. Here's some news to wake you up. A wake-up call from Janet Yellen, the Treasury Secretary. Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1st. President Biden making a move, setting a high-stakes debt limit meeting between congressional leaders on May 9th. And Tom, we just get confirmation moments ago from McCarthy's team. According to a GOP aide, McCarthy agrees to a May 9th meeting with the president.
I am wrong on this. I am hardwired to ignore it, and I'm wrong. And this, everybody tells me, the pros tell me this time is different. And what's more important, John, the market tells me this time is different. There's some real oddities in the short-term paper market, that trust market, that indicate the tension to May 9th.
Well, let's get to the markets in just a moment. Let's compare and contrast two things. The urgency of the message that came from Treasury yesterday in a letter to congressional leadership. One, June 1st. Compare that with the lack of urgency around meeting with congressional leaders May 9th. Why do we have to wait a week from now, for this, if it is so urgent?
They're going to have a May 9 meeting to decide who kicks the can down the road. Greg Valliere publishes on it this morning with many others saying the short path here, John, is to kick it out to September or maybe out further. But the answer is the American tradition is to move it down the road. And that's who's going to kick the can? Is the president going to kick the can? The speaker? Senator Schumer? He's qualified.
How much road is left?
Well, that's the key question. And this goes to the debt dynamics that infuriate the conservative Republicans. The answer, I think, across all the spectrum of the Bloomberg surveillance world is you need to grow your way out of this. How do you grow your way out of this with 1% GDP?
So here's the market question. Does this bleed beyond just the at-risk securities in the T-bill market? Does it go beyond that?
The tape is talking to me. I mean, the resiliency of the equity market, SPX near 4,200. I got a Dow print right now of 34,000 close yesterday. On and on. The VIX was a 15 handle at one point. The market is doubting the urgency and the angst of this. Makes for great theater. You know, I guess they'll do an Oval Office shot and everybody will be cozy and, comfy. Maybe they should have Roy Woods Jr. show up to run the meeting.
I'm sensing from you that you're still not taking this that seriously.
No, I'm not. I mean, the comedian that was at the White House dinner, I thought he was one of the best in 15 years. He and Sinbad. And you can have Sinbad or Roy Woods Jr. show up and it'd be a more constructive meeting.
Possibly. Let's get to the equity market. Equity futures just a little bit softer, negative 0.2% on the S&P 500. On the NASDAQ, we are totally unchanged. And I have to say, even with the deal yesterday, Tom, between JPMorgan and First Republic, no relief rally for the banking sector, no relief rally in the equity market more broadly, totally unchanged going into the Fed.
Yeah, I'm sorry I missed yesterday's festivities. We'll pick it up today with some really good insights. Stay with us, folks, for JPMorgan, First Republic through the morning. I'm looking at LIBOR. I go back old fogey to 3-month LIBOR, and I'm sorry, it is ascending persistently. It's a grind higher in short-term rates into this Fed meeting.
Important couple of days ahead. Two-day meeting begins in Washington, D.C., concludes tomorrow. Full coverage, of course, here on Bloomberg TV and Bloomberg Radio. Then it's on to Friday with the payrolls report, and somewhere in between an ECB decision and Apple earnings after the bell on Thursday. Looking forward to that. Joining us now is Jonathan Stubbs, equity strategist at Berenberg. John, you know where I'm going to go with this. TK is thinking this is the same story all over again. They meet, they complain, they kick the can, but ultimately there's not a big issue with the debt ceiling. Is that a complacent way of looking at things? Are you concerned? Should we be concerned about what's about to happen in Washington?
I'm not sure whether it's the debt ceiling itself which should be the focal point of concern, because there are many other aspects to this I'd bring in. When have we had sort of debt ceiling concerns at the same time that we've had such an inverted yield curve in the US, at the same time that we have a banking crisis with some of the biggest banks failures in history happening alongside that, and also having the US equity market trading north of 18 times forward earnings, where those are peak multiples, excluding the liquidity bubbles of the last 50 years. So it's not just the debt ceiling; it's everything else that goes with that. And the final point is what's happening in the rest of the world. We're talking about deglobalization. We're talking about frictions between the biggest economies in the world, US and China, on many levels. So the debt ceiling is one thing, but it's happening at the same time as everything else. It's everything everywhere all at once.
John, I want to address contagion this morning. One of the things I've started doing, this is in the last 90 days, folks, is I read the wonderful publication Cranes. They're in different cities around the country. One of their headlines today, Jonathan, Manhattan has almost 94 million square feet of available office space. Is one of the bank variables here, your expertise, is in Europe? Is commercial real estate challenged in Europe?
I was looking at this actually from a US perspective again for a big piece we put out last week, and it's the Castle Back to Work data that you publish or you have on your platform, and you look at that across all US cities, and it's running between 40 and 50% compared to a pre-COVID level. So we have this phenomena in Europe, in the US, around the world that. We haven't gone back to normal in terms of using office space and everything. There's a lot of sort of vacant property, and there's also more capacity being built. So commercial real estate is a key sort of risk focal point wherever we are, and I think in particular into the US banks more so than into say the European and UK banks. The lack of breadth in terms of liquidity coverage across the entire banking system in the US appears real time to present more fragility. Higher levels of regulation, higher liquidity coverage ratios in Europe suggest greater protection. But I think your broad point is spot on, and I'd reference this of Castle Back to Work because it sort of sits alongside. The empty space, the additional supply that's coming on. People just haven't gone back to work, and then you put on AI into that, and IBM over the last 24 hours saying, we're cutting back and we're going to sort of replace open positions with AI. There are lots of challenges happening here at the same time, but commercial real estate looks under pressure. Do you assume, Jonathan Stubbs, that American banking will become more Canadian and more European? I mean, I put out a tweet yesterday that JPMorgan and Bank of America combined is the fifth bank of the United States. I mean, that's really where we're heading. But do you see consolidation here just inevitable to occur? There's some great sort of financial specialist groups out there. I think many of your viewers, I'm sure you look at the Cabesi letter, I think it is. They had a great sort of picture over the last of 72 hours of the Spanish banking system and how that's consolidated over the last 10, 15 years. So we know consolidation in banks has been sort of running consistently over the last sort of 30, 40 years, to be fair, but it's really accelerated in Europe on a needs-must basis since GFC. And now we seem to be running into that in the US. So, consolidation is happening. It's happening because banks are fragile in this fragile world. And the too big to fail are reaping the benefits of getting attractive businesses at a good price with liquidity backing from authorities. So, so far that's intercepting the downside risk or passing it on. Moral hazard is a different matter within that. And it doesn't solve some of the underlying sort of risks coming through from higher rates and what that means. Doesn't solve some of the gaps between money market rates and deposit rates, and more people waking up to the fact that they can get higher sort of rates from deposit markets. So there are still risks there, but so far authorities are sort of plugging the holes.
Brilliant piece from John Authors today.
Yes.
On Bloomberg.
Yes.
Absolutely fantastic. In this piece, if you haven't read it yet, there's a quote here from a professor from Cornell, Robert Hockett. And Tom, it reads as follows. We now have two choices before us. Either we preserve our production-focused regional and sector-specific industrial banking systems by removing FDIC limits immediately, or we allow financialized Wall Street banks to take all, an outcome that would ultimately necessitate nationalization of the whole sector.
This is the heart of the matter, back to the second bank of the United States, the battle of Henry Clay and Andrew Jackson, Kentucky and Tennessee. And John, the author's piece is an absolute tour de force. It'll be a focal point here through the week.
Jonathan Stubbs, I want to give you a final word on that. The banks in America, do you see reasons to buy the regional banks in America? Because they've really struggled to get off the mat over the last couple of weeks.
Short answer, no. Slightly longer answer, from our models, we've got a bank's handbrake factor in our sector models that we look at across all regions. We've got that weight higher in the US for obvious reasons of what's happening real time. And that takes banks, towards a sort of middle rank, so sort of a neutral rank, which is being sort of selected within the sector. That contrasts with UK and Europe, where we still have this sort of risk factor on banks in our model. But banks are our top 1 or 2 sectors in our sector models in Europe and the UK. Again, better capital, better liquidity in terms of breadth across the system, more consolidated already. So our models continue to point to this preference for UK and European banks over the US. In the US, one final point, defensive sectors in the US equity market have never been this cheap going into a US recession. I think that's interesting. So you can actually get quite good protection in US equities in defensives into a recession. I think that's a really good trade to put on at this point as we go into the summer months.
I feel like we've been talking about this US recession for 12 months.
Jonathan
Stubbs there of Bloomberg, and still waiting and wondering whether we're in it right now. Big move yesterday in the ISM manufacturing number. The prices paid component of that seemed to spook this bond market.
Yes.
Throw in the Meta bond issuance as well. We had a real repricing of the yield curve yesterday, TK, even when the equity market didn't do much at all.
Well, it's there, but far more importantly, I would say it's tick by tick, day by day. You look at the correlations here of equities, bonds, currencies, commodities, and you end up going to the Bramo market. You go to the spread market, and I'm looking at very short, I've mentioned this before, 3-month papers compared to the 10-year note, and we're right down near record inversion on that, and that's this distortion. Is it the debt thing? Yeah, it's the debt thing. I'll go with that. But it's much more, John, to bet on what inflation's going to do and if the job market will allow Powell to relax. And, in the last couple of days, you're right. It's become more restrictive.
Equities right now on the S&P 500, negative 0.2% on your equity market. Looking ahead to another big week for equity market earnings. Anna Han of Wells Fargo on stocks coming up in the next hour. Looking forward to that conversation. Equity futures just a little bit softer from New York City. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. President Biden has set high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House is considering promoting Federal Reserve Governor Philip Jefferson to vice chair. Bloomberg's learned that a Latino candidate could then be named to an open board slot. Jefferson was confirmed by the Senate last year with broad bipartisan support, and that suggests he would face little opposition to becoming the Fed's number 2. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. Now, that includes 20,000 dead. The commander of Ukraine's ground forces say they have pushed back Russian troops from some positions in Bakhmut. Writers of some of the most popular shows on American TV are walking off the job. Writers Guild members are striking for higher pay at a time when there are rapid changes in the way people watch TV programs and films. One of the writers' demands is for higher payments for shows that are on streaming services. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the US financial system is sound. This is a case of a small handful of banks that were poorly managed. And getting this addressed is very important.
James Fraser, the Citigroup CEO, yesterday at the Milken conference in California. Based on some of the commentary of the last 24 hours, you probably wouldn't realise that we've just seen the second biggest banking failure in the history of the United States.
Thank you. I totally disagree with her. I understand she's a corporate officer, a public person. She's got to say the right thing at the right time. I'm glad that General Fraser was able to calm the troops. Guess what? Baloney. Everybody I talk to, it's about commercial real estate. That's one angle of it. And frankly, John, it's still about distorted interest rates. I think it is underplayed that the events that got First Republic and other banks into this mess still exist. And, the idea that there's no other banks out there, I really have trouble with that.
You saw what Charlie Munger had to say about the banks in America, some of the regionals, speaking to the FT over the weekend, basically suggesting they're full of bad commercial real estate loans. You heard from Katie Koch at Milken yesterday, the TCW Group president. You remember her from Goldman Sachs Asset Management over many years. She said regional banks is an area we're concerned about because of deposit flight, and also they have the highest exposure to commercial real estate.
I'm just going to listen to pros. And I mean, our next guest is one of those guys. They've seen all this. Gerard Cassidy was out front on the doorsteps of Continental Illinois a few years ago as they were going belly up. He remembers it.
Can I just say, we joke about analysts coming on calls and saying great quarter. Can I say great call to the analyst, Gerard Cassidy?
Yeah.
A great call yesterday on the analyst call yesterday with JPMorgan. I just think fantastic line of questioning that he addressed with leadership there.
Well, that's the experience you get. And with us now, and he's helped us so much. I think of Ken Leon over at CFRA, Michael Mayo, when we can drag him in. Gerard Cassidy up early in London, head of U.S. Bank Equity Strategy at the Royal Bank of Canada, and we welcome him this morning. Gerard, I'm going to go to the PowerPoint. I thought it was really quite nicely done by JPMorgan. I'm sure it was massaged by a staff of 42. And buried at the bottom was an internal rate of return guesstimate of 20%. You and I aren't going to go to an iterative discussion of the equation, but I fell off my chair. Is this really an IRR of 20%? Is it that lucrative for Fortress Diamond?
Tom, it is, and thank you for having me on the program from London here. And I would point out that one of the reasons the internal rate of return is so strong is that in an agreement with the FDIC, which is very common, the FDIC, when they sell these banks out of receivership, will take a loss-sharing agreement with the buyer. As a result, when you have one of those loss-sharing agreements, the amount of capital that the bank is required to hold against those assets goes down. And that's one of the reasons the IRR is as strong as it is.
What kind of pop do you calculate JPMorgan will get if interest rates actually come in, if we disinvert, if we get ourselves back to some form of normal interest rate structure? To me, it's an incalculable delta. It's just a huge number if they get the markets to cooperate.
Tom, you really put your thumb on it, because if you go back to 94, 95, and I'm not suggesting we're going to have that Goldilocks economy we had in 95, but Greenspan took rates up from 3 to 6%, and we didn't have a recession. And then he started cutting rates in 95. The bank stocks were up 55% that year. So if we don't have a big recession, as many people think we are going to have, the credit problems for the banks will not be that severe, and rates will start coming down probably next year.
You and I studied at the altar of Henry Kaufman. He was so kind to me when I first joined Bloomberg, Mr. Cassidy. Henry Kaufman is quoted by John Authors. Folks, Matt Levine, John Authors, read him today if you're part of Global Wall Street. And Mr. Authors talks about Kaufman as a quasi-public utility. Is that what we've got now with a combination of JPMorgan and Bank of America? Are they a public utility?
Tom, I wouldn't refrain too much from saying that, but other than to say they're financial utilities, and that's not a negative, that is a positive. If we could have banks that consistently pay their dividends through the cycle and also deliver, mid to lower teens return on tangible common equity, those are very attractive returns. So you could call them financial utilities, in my opinion.
Great for shareholders. I wonder if it's great for customers. Jared, let's talk about that. The deposits that they're assuming, JPMorgan from First Republic. You asked about this on the call yesterday. Jared, how do those deposits reprice? Did you get some clarity on that?
John, what happens normally in bank failures, quite often the acquirers are able to renegotiate down those rates of interest on those deposits. Not the term CDs, those are contractual. But that was the reason for the question, because that makes the deal even more attractive to JPMorgan. And quite often, and I'm not saying this happened with First Republic, but quite often what happens when these banks head into receivership, they have to pay up for deposits to bring money in. That's why the buyers get to reprice them downwards, which makes it more profitable for the buyer.
I love the way that Jeremy Barnum, the CFO of JPMorgan, addressed this. Listen to this language. I think the reprice experience will blend over time into the rest of our deposit franchise. Do you know what that means, Tom? Their deposits and their rate of return will come down to zero over time, because over at JPMorgan, Jared, they're not paying much for deposits and they don't need to. Jared, I was wondering yesterday whether you thought they were downplaying to some extent, for PR reasons, just how profitable this deal might be for JPMorgan.
John, I think you said it well. I think it's an extremely profitable deal for JPMorgan. Their size and their strength gave them the advantage. We wrote last night in our research note on this transaction that the prior two transactions, the loans were marked to market to about 77 cents on the dollar. And in the case of JPMorgan yesterday, they marked them to 83 cents on the dollar. So they didn't have to be as aggressive as maybe some of the other bidders who were bidding on this, and that was an advantage they had.
There's the math, folks. You get it from Gerard Cassidy, not from us. We go to the pros. And, John, you got a bond at par or a loan at par down to 77 cents, and JPMorgan paid up where the others wouldn't.
So, Jared, they've got experience of dealing with distressed institutions, Washington Mutual, Bear. Jamie Dimon's been there, done that. Jared, you addressed that question as well. Why is this so different? And why in 5 years won't we be sitting here rethinking everything we've just said in the last 24 hours?
John, the major difference, and Jamie Dimon addressed this yesterday to my question as well, which is this was a deposit flight, deposit run problem. It was a classic duration issue of long assets on duration, short on funding. This was not a credit problem. And First Republic had pristine credit. And I would suggest that this is a very different situation. As a result, it's not as risky for JPMorgan and the others because this is a mismatch of assets versus liabilities, and they're now going to benefit from the marking of market of those assets and the yields that creates.
Jared, wonderful coverage, as always. Good to see you in London as well. Gerard Cassidy there of RBC Capital Markets. Thank you, Gerard. At a more civilised time for Gerard, given that it's about 11 a.m.
Maybe he's over advising
right
Tottenham. I could see Cassidy.
They could use his advice right now, given the way things are going.
Yes, I think that
I love the way that the CFO responded to his questions yesterday, Tom. They said this about how clean the bank was. You basically get in a very clean bank in the most clean way that you can get it. That doesn't mean there's no risk. It just means you have a very clean bank in the cleanest way you can get it, that it didn't have those problems, referring to the problems, of course, of Bear and Washington Mutual back in the day.
And they get us, I like the single sentence someone had. I'm sorry, I can't cite it, but they get a Silicon Valley franchise overnight. Years and years to build that out, and instantly they get it. And they go in and they go to the right club and they have the right lunch, and I don't need to be cynical. Let's.
You don't sound cynical at all.
Can we get some Giants tickets? I need some get me some San Francisco Giants tickets now.
Don't we want some Lakers tickets? No.
Lakers tickets?
Basketball, Tom.
That's not Los Angeles.
We're not going to LA.
No.
California. No. Live from New York City, welcome to the programme on TV and radio. Let's check in on the price action. Your equity market just a little bit softer on the S&P 500. Equity futures negative 0.2%. Total snooze yesterday. Dipped briefly into negative territory and stayed there at the end of the session. So we closed just a little bit lower, but no real drama here. On the Nasdaq, totally unchanged going into earnings from Apple on Thursday and the Federal Reserve decision tomorrow. So a bit snoozy in the equity market. Maybe that's a good thing. In the bond market, we look like this. It was anything but snoozy in the bond market yesterday. Yesterday was kind of strange. We saw the prices paid component of the ISM manufacturing read come in and rebound. And after that rebounded, you started to see Treasuries sell off and yields push higher. Meta came to market as well, so big tech debt offering, which can push the bond market around sometimes. You see those things. Yields higher by more than 10 basis points across the curve this morning, repricing just a little bit lower, down 2 basis points on a 2-year, 4.1182% on a 2-year. On a 10-year, still in and around 350 going into the Federal Reserve. The Federal Reserve, widely expected to produce another hike and then go on some kind of conditional hold. We used to say that about the RBA down in Australia, and look what happened overnight. The Aussie dollar, much, much stronger today, positive by 8 or 0.9% against the US dollar. A rate hike from the RBA, a signal there might be more to come, Tom, and a shift, I have to say, from the Australian Central Bank.
Well, yeah, the Australian bank surprised here, and you think you're going to see a lot more surprises. And I really wonder if we're going to see a surprise here tomorrow and that no one's looking for it. And will there be a surprise in the language?
Where will it be?
Out June.
In the statement?
It's the parlor, as I said in the ad, it's a parlor game. And I don't know where it is, but everybody's, I think, way too complacent about a meeting tomorrow, given what's going on. What I see on the Bloomberg screen, John, in the short-term paper market and in some of the foreign exchange niceties, like you mentioned, AUD, there's some tension out there that's not real. We're distracted by bank stuff.
They've got a ton of things to navigate, and the new one, I wouldn't say it's a new one, but certainly it's been pulled forward, is the debt ceiling debate. The debt ceiling debate after Yellen's comments yesterday seems to have come in maybe about a month. Now, obviously, she's going to say early June, Tom, and there's going to be some time around that, maybe a couple of weeks or so.
Yeah.
They've got to be conservative, of course.
I have to admit.
But ultimately, it brought the conversation forward.
It brought the conversation forward, and early June is like tomorrow in Washington talk. All of a sudden, it's tomorrow talk as well. Let's talk to an expert on this, the dynamics, the deepest part of our financial system, foreign exchange. Head of foreign exchange strategy for the global basis at RBC. Elsa Lingos joins us right now from London. Oh, I guess we got some technical issues. Tell me, Amy, where we are right now. Okay, she just went away from us, and that happens sometimes. The signal, you know what happened?
Did you
Gerard
cut the line?
Cassidy.
He cut the line.
He goes, Gerard Cassidy's in London with RBC, and he's like, wait, I get airtime with surveillance, not Elsa. He yanked that cord right out of the wall.
Do you want to hear what Bank of America's got to say before we try and re-establish with Elsa?
Yeah.
This is what Mike Gapen's got to say. Enough juice for one more hike. He says the handoff to 2Q looks soft. We expect the Fed to hike by 25 basis points next week and signal a pause in June with a weak upward bias for rates going forward. How do they signal the pause in June? The space for that.
How do they say that?
The space for that in the statement. Because in the statement at the moment, can I finish?
Please.
Thank you. In the statement at the moment, it implies a little bit more tightening could come further down the road. I wonder how they reword that tomorrow.
They reworded in a question to Colby Smith at the FT, not to Mike McKee. Mike McKee's not going to get it because Mike is too tough.
Mike McKee's usually at the end of the news conference.
Yeah, he's at the end, and he's brutal. And so they're going to have that statement early on, and it's going to be read off a piece of paper. That's the other thing.
As it often is.
It's going to be read. He's going to be looking at the paper as he moves us forward. We move forward to Elsa Lingos with RBC Capital Markets. Elsa, I got to go to what's moving, and I got euro yen from strong yen, a couple weeks ago, out to weak yen now. It is a 5.6 standard deviation move. What does euro yen signal to the global system?
So I think on the yen side signals perhaps that prematurity in looking for yen strength. The Bank of Japan will at some point normalize policy, but certainly not happening anytime soon. For me, what's interesting on the euro side is heading into the ECB meeting later this week, it felt like a reasonably finely balanced decision between 25 and 50. And we just had that senior loan officer survey earlier this morning, just really looking like demand for loans has come off quite sharply and maybe cementing that case for a 25 hike.
Is Europe in recession?
Not yet, but I think the real struggle for people here is how long does it take to happen? You can ask the same thing in the US, you can ask the same thing all across the world. We've seen material tightening in interest rates. That's going to have an impact on demand for loans, for investment, and so on. From my perspective, I think the more interesting question is a relative one. Why invest in Europe at the moment with structurally higher energy prices without the same tax benefits and so on that you can get in the US? And why not take advantage of the Inflation Reduction Act, the subsidies, the slightly lower gas prices, and really relocate investment towards the United States?
How does that shape your euro-dollar call, Elsa?
From a cyclical perspective, I still struggle to get on board the bullish bandwagon. So it's not that I'm a massive Eurodollar bear. I don't envisage us trading back below parity anytime soon, but it's more that I think the case that Euro bulls have been making for dollar underperformance, Euro outperformance, a lot of that is already in the price, and I just struggle to see where we get the upside news from here.
I know that it's super frustrating to talk about the debt limit, the debt ceiling and the debates in Washington, but we kind of have to now, Elsa. It's unavoidable. Do you have any call whatsoever on how you expect the dollar to respond in a risk-off environment around the debt ceiling debate? Is it different this time? Do people flock to it or move away from it?
I think when you speak to investors, we all have a similar view that it's going to get resolved, but it's going to get really noisy in the interim. I think the question people are asking is that resolution, how much discretionary fiscal tightening is going to come on the back of it? I mean, if we were to see a lot of discretionary fiscal tightening, sure, that could be an argument for getting a little bit more bearish on the US dollar. But typically what we see happen is nobody wants to make difficult decisions on spending cuts or tax increases. And so it just gets pushed back. And in that kind of scenario, I don't see that playing out in a short dollar story.
Elsa, there was a game, I'll say 10, 15 years ago, where we would calculate the impulse of flows into the United States and what it would do to the 10-year yield. How many basis points, folks, how many hundredths of a percentage point would it take off? Are we going to have that discussion in the next year where there's so much money coming in to the United States that it drives down yields?
You know, I think the conversation we're having, I look at it from a structural valuation perspective, right? If the United States is a more attractive place to invest in, then you can see an argument why all else equal, the dollar would be slightly firmer. And again, I'm not some massive dollar bull, but I just struggle with this very strong bearish dollar narrative that's out there. You hear people talking about de-dollarization, the end of the dollar status as a reserve currency, and all of that may happen over the next 10, 20 years, but you can't invest on that horizon. And so I think a lot of those arguments are somewhat premature. And, you know, to your point, those capital flows do matter, both for yields, but also for slight dollar strength.
I look also at the simple call here, which is dollar weakness and what it, or strength, the assumption is weakness, what it means for our listeners and viewers. Is it a big figure move that will have an impact on portfolios, or is it the speculative noise of the foreign exchange market? It pains me to say it's just speculative noise on the FX market because, you know, as an FX analyst, I do think there is good alpha to be had there. But to your point, Tom, maybe the US dollar is not the best place to find it this year. And so maybe investors outside of the FX market can probably afford to pay a little bit less attention to it this year than they did last. See how polite she is to me.
Very
she
diplomatic.
wanted to stand up and walk off the set.
I'm sure in the future she might do. There's always
she
that
has
risk.
in the past.
Elsa, thank you. Elsa Linios there of RBC. Looking ahead to a couple of central bank decisions this week. We've got the ECB on Thursday. Tomorrow we've got the Federal Reserve. The ECB, we're looking for a 25 basis point hike. Let's see how big that debate is, whether they should go 50 basis points. I know you're distracted. Yeah. I know also, this is, okay, let's get to this. You are a subscriber to Autosport.
Autosport, yeah.
Okay,
on radio,
when did this happen?
It's great.
When did this happen?
Vet Bill insisted, because we're watching early in the morning. I was as confident as I could be, being 1 second off the pace, which is not really confident.
Who's that?
Alonso.
Fernando was disappointed at
This
Baku.
is a couple races ago. No, not at Baku.
Okay.
This is like, it's a magazine. It's dated. You know, you can go to Autosport website.
How old is said magazine?
This said magazine, I think we're very Bahrain. Aston Shocks at Bahrain.
Okay, so you're like a month. You're like a month or so behind.
Well, yeah, with F1 Sport, I'm like 2 years behind.
Did you watch the race over the weekend?
I watched every minute of Baku. I sat, you know, I came in, I didn't get any sleep. I was up until 4 or 5 a.m. at the White House dinner, going to 4 or 5 parties, and came in, I just turned the telly on, and there it was.
And watched the race.
I love that ESPN has only the British announcers. Because, John, if it was American announcers, it'd be Stroll, his story as the son of a billionaire.
What's this?
That
golf.
would be.
This is the golf. They do the golf commentary.
Yeah, you know. Well, this started with the Olympics. Help me, folks. Up close and personal, which John doesn't get, but there was this whole American up close and personal. Lance Stroll.
It's always bio. It's always bio.
Yeah, it's all touchy feely stuff, and the British are just like totally focused.
You know why? Because
on the
ESPN
race.
are using Sky Sports coverage of Formula One. and they're putting it on ESPN over here, which I find kind of odd, but that's what they do.
We're going to talk about this, folks, but this is not like baseball where Fenway Park is different from Yankee Stadium. Azerbaijan was like on the streets. In Miami, am I right, Steve Ross built it? It's like
I do not like the Miami track. We could talk about this.
I don't have an opinion, but it's totally different, right?
It's like in a car park.
That's like Abu Dhabi's that way?
It feels like it's... No. Miami feels like it's in a car park, in a parking lot.
Okay.
Yeah.
Would you go to the race? The TV coverage is so good. Why would you go to the race? Other than to be in the pits?
The sound of it. The sound of it. The smell.
It smells?
Yeah, just all of it. All of it. You know, sensory overload. Very cool. Very, very cool. I think you have to experience that up front.
Okay. Maybe that we can get from Red Bull or Ferrari or Aston Martin coming up.
We've got
here
Aston
in a
Martin
bit,
next, which is why we're talking about this.
Do you think we can get pit? They could take the three of us and we could be like in the pits?
You'll have to talk to him. Yeah. Mike Crack's coming up, the Aston Martin F1 team principal.
Very cool.
That conversation just around the corner. Ask him. See if we can do the show down there.
It's that noisy because you can hear it on TV.
You wouldn't hear anything.
Yeah, okay.
You'd have to wear those headphone things.
Oh, could you?
You know?
Do I get to wear the thing with all the labels on it?
The overalls.
Yeah, they're going to do that to baseball. Right now, baseball has one label. I can just see in 10 years, baseball's going to have the labels all up.
Why have they been reluctant to do that in baseball?
There's a purity to it. I mean, it's like the Red Sox uniform, the Phillies uniform. It's
right. Well, people are excited for this interview now, Tom. No doubt about it.
They are. I got to read in.
We'll catch up with the Aston Martin F1 team principal. We'll do that next from New York City. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. It comes after the Treasury Department warned the nation risks default as early as June 1st. The White House has said it would not negotiate with Republicans over extending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that's switching to a targeted coverage approach where business accounts get more coverage than the current cap would be the best option. That will require Congress to act. In the UK, there's a sign that households may be past the worst of an inflation shock. Heavy discounting on clothes and furniture pulled down shop price growth for the first time this year. Shop price inflation slowed to 8.8% in April, down 0.1 of a percentage point from March's high. But grocery bills kept climbing, hitting an all-time high of 15.7%. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Many of the cuts are expected to take place in the banking and trading group. And HSBC will buy back as much as $2 billion of stock. The London-based bank will also resume paying quarterly dividends for the first time since 2019. HSBC first reported quarter results that beat estimates. Pre-tax profit tripled to $12.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the resiliency that you're seeing in terms of that consumer spending speaks to the fact that so much of a mess was cleaned up during COVID from all the stimulus programs and all the time that people were forced to spend at home. And that strength is now coming in, and it's an asset and a buffer for this economy, and it's showing up in those consumer earnings results.
Laurie Cavacina there of RBC Capital Markets. Great to catch up with Laurie. It always is. On the equity market, you get a bit more earnings this week. Thursday, after the close, it's Apple. A ton of central bank decisions. We had the RBA overnight. They hiked interest rates by 25 basis points. A surprise against the consensus consensus view, looking for the Fed to go 25 tomorrow and potentially the ECB to do the same thing on Thursday. Just to bring you an update on the debt ceiling debate. So yesterday we heard from the Treasury Secretary Janet Yellen in a letter to Speaker McCarthy and other congressional leaders from both parties. The Treasury said, our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1st. After that, we learned pretty quickly that the President had set a high-stake debt limit meeting between congressional leaders, invited them to meet on May 9th. I would have to say there's a bit of distance for me between being urgent about June 1st and then saying, May 9th we're going to have a meeting, which is a full week away, but there we go. McCarthy agreeing to that May 9th meeting, according to a GOP aide in the last hour, Tom. So next week, all to play for. The beginning of a long, long road towards the X date.
They get a Fed meeting. They get some jobs data. It's critical. I believe that's May 5th, Friday, in this hugely busy week. I don't think they really care about it. My take on the White House Correspondents' Dinner is they're completely focused, as they should be, on the election. And it's all politics. It's got nothing to do with economics or analysis or what CBO thinks and the rest. I just think it's a political ballet on May 9th.
If it's all politics, May 9th and going into the debt ceiling debate, then ultimately it is for the election, isn't it? Isn't this about setting the stage for the election?
Setting the stage and placating your constituencies more than anything. I'm not sure what Joe Biden's constituency is. And is he playing to the middle? Is he playing to liberals? I don't know. I think we got to learn something about that.
Let's see if we learn anything next week. We'll see.
Well, we'll see. This week we're going to learn something. It's incredibly busy this week, and sandwiched in it all is Uber's earnings. Of course, Uber, even more important now, is their competitor, their small competitor, Lyft, with some real jobs cuts. We're going to talk to Mandeep Singh about this, senior tech analyst for Bloomberg Intelligence. Mandeep, I've got one question for you. It's a hugely cultural question around your expertise on Silicon Valley. So I'm going to rip up the script here at the beginning before we get to Uber. What are people in Silicon Valley going to do today? Are they going to be comfortable switching from their bank, First Republic, to a ginormous monstrosity like JPMorgan? Culturally, can people like you make that switch?
Well, and now you can throw Apple in the fray as well, because, they're offering those kind of yields where they're trying to attract consumer deposits. So look, I think right now everyone realizes that, you have to get some yield on your cash, and there is safety towards larger banks. But I think Apple's entry in this space is quite interesting because clearly they have a long-term vision in terms of what they're trying to do. I do agree with that, how they do it without being financial, without being a bank. Let's get over to Uber right now. Just, basically thumb up, thumb down. How is their quarter? How is their year going? I think I would give a thumbs up simply because, what everyone has realized is the only way you can make money in this business is scale. And Uber, has that scale when it comes to the supply side. Even on the rider side, they have that organic momentum. Now, I would caveat here, Uber's mobility business looks far better. We know that the delivery and freight is a drag on profitability. And when you look 3-4 years out, I don't even know if this company can be a high growth company. So for me, this is more of a margin improvement story from now on. And as long as they keep, mid to high teens growth and keep delivering on the margins, I think you can say it's currently not valued as a tech stock, as it should be. I think all these companies should be valued as a logistics business, but clearly Uber has the scale.
Mandeep, how does that compare with Lyft?
Lyft, I think things aren't looking very good, even with the CEO change, even with the job cut announcements, because they're struggling with the driver supply. And in this business, if you can't manage your ETAs, there are no switching costs. Those consumers which were using Lyft can easily switch to Uber or DoorDash. And I think that's what they're struggling with. Now that they have to announce job cuts to improve profitability, that's like a double whammy, and I don't see them coming out of this anytime soon.
Mandeep, is there any lever that Lyft can pull? What can they do?
So we highlighted B2B partnerships. Look, if you start looking at all these companies as a logistics business, they're competing with Amazon at the end of the day, and Shopify and all those type of businesses that layer e-commerce and logistics together. And that's where, they can partner with a Walmart or a Target. Really, you need scale. That's the number one thing, you need as a marketplace. And the B2B side of things has much bigger scale. That's what Grubhub did,
Right.
Partnering with Amazon.
Mandeep, I'm looking at the financial analysis screen of the Bloomberg terminal. You've got something to do with that. And the cash flow switch of Uber from minus 4 gazillion out to a positive 4 gazillion 2 years out is extraordinary. How do they flip that cash flow to such a constructive statistic?
I mean, look, I still think it's bloated. They're spending about $10 billion or $9 billion in, cost of revenue and OPEX, and that's too high, a quarter. And that's the reason why no one has understood why these companies are, so bloated in terms of their cost structure. The R&D expense of, $800 million a quarter, that's too high when all of your consumers are coming directly to your app, sales and marketing of $1.2 billion. So clearly there's a lot to be fixed on the cost structure side, and Uber has the scale, $30 billion in annual revenue run rate. Guess that's what they're doing, paring down the costs, and that's what's driving.
So, John, it's like Meta buys them. I mean, Zuckerberg's now the new cost-cutting king. Meta buys Uber.
You see the Meta debt deal yesterday?
Yeah.
$8.5 billion.
Yeah, it's amazing. And, that goes to the heart of it, how Uber is not Meta. I mean, I'm looking at the WACC screen on the terminal, folks, weighted average cost of capital. Mandeep invented the screen. And Mandeep, Apple and Meta are out with a debt cost of 3.3%. Uber's like at 6%. And that's, to your point, is it a tech company? If it's not a tech company, what's a logistics company? Is that like they're really competing with FedEx?
Yes, and they probably will be valued at 6 to 8 times EBITDA, which is what a typical logistics company is valued at. So I think what market is really waiting for is how much the profitability, and look, this is an adjusted number, so it's not even a GAAP number, but they will get the benefit of doubt as long as they keep executing on that EBITDA line. And I think the delivery side of things, that's where they've started to layer on ads. That's a $500 million run rate business. That will be key to operating leverage on that delivery side, because Uber wants to be that super app, but so far we haven't seen that synergy between mobility and delivery. I think freight is a distraction. They'll probably spin that off, but it may take a couple of quarters to go with that announcement.
Hey, Mandeep, wonderful to get your perspective. Mandeep Singh there of Bloomberg Intelligence. As we wait for some numbers from Uber, should be coming in the next couple of minutes. When we get them, I'll share them with you. Tons of bond offerings yesterday. The team here at Bloomberg putting it all together. 11 companies coming forward with bond offerings yesterday. This really knocked around the Treasury market a little bit, Tom. Contributed to that move higher in yields on treasuries.
Wait, interest rates are higher. Why would there be bond offerings? And the answer is CFOs are like lemmings off a cliff. They're looking at the trends. And it's not so much they're saying lock it up, get in there, but they want to create a constant stream as yields go up. And of course, the other side is they're going into the CEO and the board and saying, look, rates are coming down.
Well, they're certainly lower than where they were 2 months ago. That's for sure.
Yeah, and
take the 2-year piece in a treasury market.
What does Apple do?
That maturity's gone from north of 5 to south of 4 at one point. A little bit north of 4 at the moment.
Let me get it up for Apple here. We can do this on the Bloomberg, folks. WACC go. Apple, oh my word, they have 5.1% debt. I mean, it's a crushing burden at Apple. They're not going to announce this the day of the earnings, which is tomorrow, the next day rather. But a week afterwards, they come out and they do it. They just do a debt offering to do a debt offering. They have 94.9% equity, which, is VBODI 101 is not what you do.
First look at Uber. First quarter revenue, $8.82 billion. The estimate, $8.72. It's a small upside surprise. That's first quarter revenue. This is their outlook for second quarter adjusted EBITDA, $800 to $850 million. The estimate, $757.7 million, so slight upside surprise there too. We're up by 3.8% in the pre-market on Uber. Tom getting a little bit too excited about this interview with Aston Martin F1 team principal. It was not now, it's in the next
Mercedes.
hour. It's in the next hour. It's about 50 minutes away. You're excited?
Yeah, I'm reading it.
Okay.
It just makes sense for First Republic to be a part of a large money center bank like JPMorgan.
The fact remains that there is still a fair amount of stress in the banking system.
There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem.
It's hard to divorce the Fed's actions from what's happening in the banking sector.
The sad thing is the Fed is going to now regulate these smaller, medium-sized banks when it was Fed policy itself that caused this crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market negative 0.1% on the S&P 500. What a week we've got lined up for you. Down in Washington, the Fed's two-day meeting begins, led by Chairman Powell, concludes tomorrow. This market looking for a 25 basis point hike, and then who knows? Maybe a pause from there. And then on to the ECB on Thursday, onto payrolls on Friday. After the bell on Thursday, Apple earnings just around the corner as well. TK, that's a big couple of days ahead of us.
Huge couple of days. It's the character of it and some of the surprises along the way, like the Meta bond transaction of yesterday. We've got the Uber earnings. We can get to that Marriott out moments ago. But to me, what it is about, John, is a summation of we're here. We're at some restrictive point. We've seen the Fed come on. And frankly, June is way more interesting than this early May.
You want the earnings? Uber came out moments ago. First quarter revenue, $8.82 billion. The estimate, $8.72 billion. Upside surprise, stock is higher in early trading.
Are they a monopoly?
Marriott International. Here's one for you, Tom. First quarter revenue, $5.62 billion. The estimate, $5.39. First quarter EPS, $2.09. The estimate, $1.85. Better again. And they've raised their guidance for the full year 2023. The stock is higher by 1.6%.
Part of that travel business, I guess Uber's sort of the travel business. I guess I don't want to go there, but the fact is they're both about moving people around in an economy. I think the recession talk has ebbed a little bit. I mean, it's sort of like a stagflation talk, like a 1% talk. I don't see a lot of negative GDP chit-chat out there.
It depends what you look at. You go to the airport, show me a recession.
Yeah.
Absolutely crazy to travel right now in America and across Europe, I'm told as well, Tom.
Yeah, I think it's great. Of course, we got the follow-up on the bank news with some brilliant stuff. You mentioned it earlier, but we really need to signal out, folks. You need to get smarter on the bank stuff. Start with Matt Levine and John Authers. They
Authers was great today.
Absolutely kill it.
He was
for
fantastic.
Bloomberg Opinion. It's like I get goosebumps over the acuity of how both of them are writing on this, and they're each in own different ways.
Can I go back to that quote from Robert Hockett, a professor at Cornell?
Yes, yeah.
In Author's piece. This is so important. We now have two choices before us. Either we preserve our production-focused regional and sector-specific industrial banking systems by removing FDIC insurance limits immediately, or we allow financialized Wall Street banks to take all. He goes on to say an outcome that will ultimately necessitate nationalization of the whole sector. Now, that sounds like pretty extreme, pretty drastic stuff, but did we take a step towards that kind of scenario yesterday?
And the key word there's financialization. I was talking to a fan from Australia last night, and I said, look, I'm sorry, this stuff is complex. And Dr. Alaria, an expert in game theory, was channeling a gentleman still alive named Lipsey in Lancaster, and I think it's in the 50s. Lipsey and Lancaster wrote a definitive paper on the second best choice. This is really important. We're also simplistic. We look at the best choice out there. And if you can't make the best choice, what happens when you go, oh, God, I guess we'll sell it to JPMorgan? And those are totally different dynamics. And there's theoretical foundation, as Alarian talks about, to the actions of surprise we saw yesterday.
And the second best choices that central banks have to confront now, starting with tomorrow, the Federal Reserve. Let's touch base with a price action for you, just briefly on the equity market. The S&P 500 negative by not a whole lot. We're down by 0.16% on the S&P 500. If you check out the bond market, yields look like this on a 10-year. We're down about 3 basis points, 353.57 on a 10-year. And just to finish on the euro, inflation came in a little bit hot in the Eurozone a little bit early this morning. Still sub 110, 109.60 on the euro, Tom. On that currency pair, negative 0.1%.
3-month LIBOR, 5.34%. When do we start talking about six handle on some of these short-term rates? I mean, that's inflammatory. I get it. We're doing TV, folks. Stay with me. But I'm sorry, that's a big number.
I'm with you. Sure, but this is going to depend, Tom, on how far the central bank's going to push it. And if the RBA is any kind of example of what we might see from the Federal Reserve in our future, a hawkish surprise. I'm not sure we're looking for that right now.
Yeah, it's interesting to me as well. Should we get to our guest?
We should. She's around the table with us, usually on the other end of a camera. Anna Han, it's been good to see you in person. Thanks for being with us. From Wells Fargo, as Tom just moves his Autosport magazines away from
moving. You want to read a copy?
The table.
We have Aston Martin coming up. Do you watch F1?
I do. We spoke about Lewis Hamilton last time.
You're a Mercedes fan, aren't you?
Mm-hmm.
We'll catch up with Aston Martin later this hour. We'll talk about Fernando, who's rumoured to be dating Taylor Swift, but...
Fernando is?
Yeah.
Oh, my word. I'm so
that?
far behind in the gossip.
On the internet gossip, the rumour that Fernando is dating Taylor Swift. That's a story for another time. The Wells Fargo equity strategist joins us now to talk about stocks. Anna Han, you and a team. Chris Harvey, leading the way for equities at Wells, looking for a 10% correction at the headline S&P 500. What is it that you see that's going to lead to that correction?
We're seeing really margin compression. We think that earnings are slowing. And right now, where earnings projections are as we go through Q1 reporting, they continue to believe pretty much a flat growth year over year for the S&P 500. We think that's too optimistic. So we're bringing our EPS number down about 10% contraction in EPS growth. We think that's very reasonable in an environment that you expect GDP growth, slowing consumer, and still inflationary pressures. So you put that and you tack on still a pretty reasonable multiple of 18.5. That brings us lower.
How does tech absolutely crushing it over the last week factor into your call?
Absolutely something we're watching, but we think that it's getting a little ahead of itself right now. You are seeing as well, why is that running ahead of itself? The yield markets. You're down with the 10-year around 3.5. That is a move already expecting Fed cuts. The market is expecting cuts after this meeting. And again, that's just too soon for us. I think that realization and people having to move forward or out their expectation for monetary easing is going to make things a little tougher in this summer.
To challenge your mathiness at Yale, and I'm thinking of Nassim Taleb, the great quant finance guru, on the tail risks out there. If I look at the tails of the distribution, the risks of the distribution, good and bad, out to next year, can you see them, or is it as opaque as you've ever seen?
I certainly think there are things top of mind, actually, and that's what's got things so interesting. We know what to look at. We're just not sure how to weigh each one. For example, we're looking at the commercial real estate space. That's been a hot topic. What's going to happen if those loans can't get renewed? Another one is student loans.
Right.
How does that impact consumer spending if student loans don't get dismissed? We're looking at these kind of factors. And as well, what if the Fed really doesn't start cutting? What if they just pause and hold because inflation is sticking?
That's the litany of worries that all of our listeners and viewers have. There's got to be a good side of this, and that the SPX has recovered from a great bear market. We're back to negative 3%, whatever it is, 12 months trailing. You're basically saying take the summer off and take the rest of the year off, right? When you take the summer off under Anna Han, Wells Fargo Economics, do you go to cash? How do you take the summer off based on your 4,200 call?
I think actually rather than go full cash, we're not that bearish yet. We do think you can weather through this by looking at those secular growers. I still think there's opportunity. And you look in the cap goods space as well, for example, and you're seeing that volumes are actually holding up. And all other sectors, especially even in something like staples, like food area, you're seeing volumes shrink. So there still are opportunities to keep that growth, to plow through what could be that rough summer we talked about.
I know it's difficult to identify specific names with you, so I'm going to be delicate about asking this question. Are the cloud names secular growers still?
Oh, well, you know, as someone who believes in that technology and certainly uses it and believes in the computing power of it, I do still think that there's growth opportunities. But like we said, especially with the software space and tech itself overall has had such a hot run, it's not somewhere where I'm ready to really pour in the investments now.
So what is a secular growth story that you do want to get behind at the moment?
So besides the crop goods space, where we do like as well media and entertainment, and now again that too has had a great start to the year, we still think that it's attractive. We still think there's opportunities, and a lot of it is thinking about where consumers will continue to spend even as they have to tighten the belt. And part of that is really in the experiences and the services that they can enjoy.
Can we get an extra level of detail here? Is this Tom spending more money on streaming apps? What exactly are you talking about?
It could be him watching more F1 and spending there. That certainly is true. There is that push. But again, it's more of what is going to relatively outperform when people start pulling back on their spending, pulling back on the revenge travel spending you were talking about, how those prices in airlines are still expensive.
So you think the airline story is done? Can I go that far? Do you think it's done?
I wouldn't say it's done, but it's not somewhere where if I had cash to put to work, where I would rotate into right now.
Okay, TK, that sounds like it's done.
I look at the Wells Fargo economic call and your economics team looking at where GDP is there enough nominal GDP to keep this game going? To me, that's the heart of the matter. How do you fold in Wells Fargo economics into your equity analysis?
So our expectation for actually GDP growth is just above 1% for this year, but pretty much a flat 2024. And that is concerning, but I think the sharpest pain points where we see the most GDP contraction is 4Q and 1Q. 4Q of this year and the beginning of next year is going to be the toughest drop in GDP. But that doesn't necessarily align with when we expect to see the toughest earnings contraction.
Okay, just to be specific about that, just final question. When is that earnings contraction? What's the window that you and the team are looking for?
We think really it's this year, and we think it's already occurring. You already have been seeing those margins come under pressure, and you've seen that 4Q of last year earnings came in a little lower than projected. I think that continues, and these are the quarters now where it's going to be toughest. That realization is what's going to push equity multiples and equity levels lower.
Anna Han of Wells Fargo. Anna, great to do this in person. Wonderful. Really good to see you. Thank you. The team at Wells Fargo looking for a 10% correction in the next 3 to 6 months off the back of earnings, Tom. Apparently we're about to go through a
S&P
rocky patch.
points. I mean, you're going to go 4,200 down to what, 3,800, 3,700?
Which is basically the range of the year so far, 38 to 42.
Yeah, I think everybody's got an opinion here, and it centers to me around this recession call and economic mind. As I said, I think the recession call's drifted away a little bit.
It has been pushed back.
Yeah.
At what point did the bears just capitulate? Stop pushing back the thesis?
I haven't felt that yet. That's a really important question.
I haven't seen it either.
I haven't seen mentally fear of missing out really jump in, except in the tech, and that's a little different story. Like we'll see with Apple on Thursday.
Anne Maletti at Allspring Investments. She's going to join us in about an hour. Looking forward to that conversation. And later this hour, we'll catch up with the team principal of Aston Martin F1. I'm convinced you're actually just reading in. You're doing your Aston Martin research.
I got my Mercedes magazine here because
how much is an Autosport? How much is an Autosport subscription? What are we talking about?
Well, you get it, but it's got the British font, which I can't even read. I need a magnifying glass to read.
What is that? $10 a month?
It's like it's like huge. It's like $500-$600 a year.
Seriously, that much money?
Yeah. Well, I have a full digital package, and I get. They're in the pits during the race, giving me.
Like you and 2 other guys in Manhattan have that subscription.
Here, what's next for Mercedes?
From New York City.
There you go. We're giving out party favors here.
Down 0.1% on the S&P. This is Bloomberg.
I was waiting for that sound effect, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. President Biden has set a high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. That includes 20,000 dead. The commander of Ukraine's ground forces say they have pushed back Russian troops from some positions in Bakhmut. Uber reported first quarter earnings that beat estimates. Consumers continue to spend more on rides and food takeout despite rising prices and an uncertain economic outlook. Uber saw fewer than expected monthly users. Still, ride-hailing bookings beat estimates, and that's an indication customers are taking trips more frequently. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
We've got a lot to do, and the most immediate thing we can do is ensure the continued reliance of our economy and the financial system. The most important thing we have to do in that regard is to make sure the threat by the Speaker of the House to default on the national debt is off the table.
The President of the United States speaking there on the debt ceiling in the United States of America. Janet Yellen, the Treasury Secretary, with a wake-up call to start the week, writing in a letter to Speaker McCarthy and congressional leaders the following. Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June, potentially as early as June 1. The actual date that Treasury exhausts extraordinary measures could be a number of weeks later than these estimates. Tom, a bit of a wake-up call, I would say, not just for congressional leadership, but also for the administration as well, who offered a meeting to Speaker McCarthy and others as soon as May 9th. We understand, according to a GOP aide in the last hour to start this morning, that Speaker McCarthy will be attending that meeting.
This is real politics, and it's really important with the modern polarities that we have, John. This is a fact that they have to get it done, and I think that's one trump card the president has. He has decades and decades of experience of getting it done. I would go back to the Watergate era, where you had Howard Baker, Sam Ervin, and others understanding with President Reagan, you have to get it done. And that's missing today. Maybe that May 9th meeting gets you there.
If it is June 1, and it could well be a number of weeks after that day, and Treasury has acknowledged that fact, Tom, it is a solid month or so earlier than I think a lot of people thought it might fall. One, this, of course, comes off the back of the tax receipt date that we got a number of weeks ago, which indicated that might be the direction of travel. But here's the point that I want to make this morning, Tom, off the back of this. June 1 sounds urgent, important, let's get things done. Waiting a week to have a meeting doesn't sound that urgent, does it? Waiting a week? May 9th?
No, I agree. I mean, I totally agree with that. I mean, it's waiting a week to get more data and also, frankly, to see what tax receipts do as well. Anne-Marie Horton joins us now, Bloomberg budget correspondent. And we go, Anne-Marie, to a May 9th meeting. Let's frame the look here. Politics is all about the look, Anne-Marie. Is it in the Oval Office, on the Oval Office couches with everybody smiling?
I presume so. I have not been briefed on the optics, the look and feel, the style of this meeting, but normally all these meetings, it's the President of the United States, they happen in his Oval Office. To John's earlier point, the reason why likely this is not set for this week, given the fact that the Treasury Secretary is saying the X date, the time that Treasury can exhaust their special accounting measures they've taken since January could be as early as June 1st, is the House is not in session right now. When President Biden picked up the phone and called Speaker McCarthy, he's in Israel leading a Kodel there. He spoke to the Knesset yesterday. So this is also probably why they have to push it out to next week.
Sure.
And this also just shows how short of a timeline these individuals have to get a deal done, because the House is on recession in recess this week, and then there's going to be another recess for both these chambers. We're working about 3 weeks here, and in that time, the president is also going to be abroad in Japan and Australia.
And the travel itineraries there, I'm sure you'll be with them. Anne-Marie, the answer here to me is there's a process, not so much who blinks first, but who sits down in the Oval Office on May 9th and says, we ought to do this? Is it Biden or the House?
Well, Biden has decided to invite the leadership of Congress. So that's Hakeem Jeffries alongside Speaker McCarthy, of course, McConnell and Schumer. McConnell has made it very clear. Now, this is Mitch McConnell's obviously Senate Minority Leader. He's the one Biden was able to get a deal done when we had this problem last time. But he has really said that he is going to defer this to Speaker McCarthy. And I don't think we're there yet where he is going to step on the Speaker's toes. He's going to let him lead those negotiations. But to provide some cover, the White House invited all four. So congressional leadership is all invited to the White House for this meeting. We do know that Speaker McCarthy will be the one that's he has accepted, and all eyes will be on him because he's been asking the president for another meeting since they first sat down February 1st. And in that time frame, Speaker McCarthy was able to get a win. President Biden kept saying, show me your plan. Well, he did. He showed him his plan, and he got it through his House. So now really the ball has been in the White House's court. The issue is at the moment, the White House continues to say they will not pass a bill regarding the debt ceiling that is not clean. And that is something that Speaker McCarthy says he will not do as well.
So, Anne-Marie, walk me through how you think this is going to play out next week. Get to May 9th. What does May 9th look like?
May 9th is a conversation in the Oval Office. if the X date is fast approaching on June 1st, potentially what many are saying is you can just see this kick the can down the road. But I'm not sure how far they're willing to do that. Maybe they kick it to September when they have to come up with a budget. There could be a path potentially where every side has a little bit of a win if they go to September and at the same time they pass a clean debt ceiling bill, but also a budget that has spending cuts. But potentially they are separate bills. So McCarthy could come out and say, yes, we obviously raised the debt ceiling, but we did so by extracting spending cuts. And Biden can say, I was always up for negotiating spending. The issue was I wanted a clean debt ceiling bill. That's one potential. But there's a number of ways this can go. Some are saying potentially it gets cut in the Senate, and then Democrats in the House are the ones that have to sign up for it. And Speaker McCarthy potentially that will lose some of his members of the far-right caucus. This can go any number of ways. The big issue is they don't really have a lot of time.
We haven't talked about Senator Manchin a lot recently. He talked yesterday.
Good point.
He was a key player in passing the Inflation Reduction Act. Anne-Marie, what did he have to say yesterday, and how could that factor into these conversations?
Well, Senator Manchin has been a headache for the administration throughout really Biden's entire term. But most recently, there's some parts of the Inflation Reduction Act he does not like how it's being executed that he voted for. But also, he was the one that came out and after Speaker McCarthy was able to pass his debt ceiling lift plus spending cuts package through the House, Manchin said it is time for President Biden to sit down with McCarthy. Manchin made it clear he doesn't agree with everything that went in that bill, but he said the bill right now is the only game in town. It is the only debt ceiling bill that raises the debt ceiling at the moment, and Biden needs to get in a room with him, and that's what we're seeing happen. That's going to happen May 9th.
We've all seen this movie before, and we know the ending, or at least we think we do. And this is kind of how we started the conversation on this programme this morning. Tom and I were talking this over, Anne-Marie. I'm sure you saw some of it. Is there a sense in Washington from people you speak to that it might be different this time, based on how things are going?
I think everyone tries to say we've been here before, as you just mentioned. We will always get there. The concern is, of course, with how fractious you have the Republican Party, especially in the House. Many people will point to the 15 rounds it took for the Speaker, McCarthy, to become the Speaker of the House, and that there's many in his party who want such deep spending cuts that no Democrat is ever, or even some centrist Republicans potentially, would never sign up for. But obviously, the bill they've passed, that's their beginning negotiating salvo. You're going to always get less, not more. But there is concern that potentially this time is different, and many are talking about 2011, when the U.S. was downgraded. Even though there was negotiations happening at the time, the U.S. still was downgraded at that moment. So that's what everyone is pointing to. That's what the concerns are. I think we'll have a little bit more clarity May 9th.
There's always something to worry about. AMH in Washington. Anne-Marie, appreciate the coverage. I'll catch up with you a little bit later this morning to go through all of this all over again. And hopefully we've got an update from someone down in Washington. Here's an update from Citigroup. The team led by Andrew Hollenhorst looking forward to the Federal Reserve tomorrow, and the communication of Chair Powell and the team saying this: financial stability risk can never be taken off the table, but the acute period of negative headlines looks to have passed. The team at Citi saying that means the Fed policy path once again becomes a function of incoming data. Tomorrow's statement, they say, will likely keep options open for further rate hikes beyond the 25 they expect tomorrow.
Sounds about right. And what's important is people looking for low rates, I think, would say the same thing. We got to go past June.
Terry Wiseman of Macquarie in the studio, joining us next. Looking forward to that from New York. This is Bloomberg. In a couple of hours, the Federal Reserve wakes up in Washington. I stress in a couple of hours because it's still early days, Tom, down in DC, isn't it? 7:30 Eastern time. They take their time in the mornings.
8:30 is early.
8:30 is early.
8:30 is early.
8:30 is early.
Yes.
8:30 is like in New York, 6 a.m. in Washington, D.C. They'll be waking up shortly and starting their two-day meeting at the Federal Reserve. That concludes tomorrow. 25 basis point hike, very much on the table. After that, who knows? Here's the price action going into it in the equity market, negative 0.15% on the S&P, totally unchanged on the Nasdaq. A snooze yesterday, no relief rally in the equity market yesterday, even with the banking solution at First Republic acquired by JPMorgan, and no relief rally in the regionals either. The KBW Bank Index more broadly, it's basically unchanged, didn't really do much at all. Outside of that, into the bond market we go. This did reprice yesterday, which was pretty interesting. Tons of corporate debt supply came to the market yesterday. Yields pushed higher. We had an ISM manufacturing read with the prices paid component. Just a read on these kind of things, pushing up prices, and yields were higher off the back of it too. So yields were actually up by more than 10 basis points across the curve yesterday, including at the front end. We're at 4.1286% this morning. We're down about a basis point on a 2-year. I wanted to finish on foreign exchange and have a look at Australia. Just briefly, the RBA coming out with a surprise rate hike. Consensus was no change. They delivered 25 and signalled maybe more was to come. The Aussie stronger by 1 full percentage point against the US dollar this morning, Tom. Teeing us up for a broader conversation about hawkish surprises around the ECB and the Federal Reserve through the next 48 hours.
And is out of China reopening. The reports out of China on their May holiday is it's absolutely packed with a consumption oomph in China. And Australia is hardwired into that, going north across the Pacific Rim.
I understand from the team here at Bloomberg Economics that it's a little bit different, that maybe they're willing to tolerate softer growth in favour of focusing on bringing inflation down in Australia. A shift, if you will, around the balance on those two things since the last meeting.
And it's a cultural differences nation to nation, as New Zealand is acclaimed for being rules-based as well. Right now, and this is a joy as John and I continue our coverage of this banking crisis, it pays to have somebody with real-world experience. He is global currencies and interest rate strategy at Australia's Macquarie, but far more, Terry Weissman is something that has lived what so many other people are doing. I want to go back to Alan Schwartz, David Malpass, John Riding, you, Emmy Shio, and it blew up in March of 2008 at Bear Stearns. From your distance but your tangible experience of collapse, how is JPMorgan different in 2008 than JPMorgan is in 2023?
Let me, instead of speaking about JPMorgan, Tom, let me just talk about the banking sector generally. 2008 was, I think, qualitatively different than the situation we're seeing now for the banks in the United States. In 2008, you had a situation where the primary problem at the banks was the asset side of the balance sheet. It was generally a situation where there were too many mortgages that went bad too quickly. That's an asset side problem. It's a collateral side problem. What we're seeing now is different. What we're seeing now primarily is deposit flight. In other words, it's a liability side problem. It's lack of confidence in the banks. Yes, it may be lack of confidence in the banks because people are worried about their ability to continue to honor their obligations, their liabilities, their deposits. But nonetheless, this is a crisis that has started from the liability side. And I think that makes it qualitatively different. It actually makes it easier for entities like the Federal Reserve to solve, because the Federal Reserve has backstops. It could come in and replace the liability side that the banks are losing. Right. If $1 of deposits leaves, the bank can simply go to the Fed and borrow from on the primary credit facility or from the new BTFP and get that dollar back, rebuild its base of liabilities, and continue to do what it's doing. So I think this is qualitatively different than 2008.
And can interest rates assist government institutions, and can interest rates assist JPMorgan here by getting the wind behind him over the next 1, 2, and 5 years to make this easier?
There's nothing better in promoting confidence than economic growth. Nominal income growth, certainly, because obligations are typically in nominal terms. But if you can't get nominal growth, you might as well just get real growth. I guess the question comes down to, do lower interest rates help growth? I think they do, right? If the Fed were to lower interest rates these days, certainly you would get some inflation, presumably, but that would be coincident with nominal growth. It would help corporations, bank, and every obligator in the economy honor those obligations, honor their debts. I think that would reduce the amount of financial stress in the economy.
Let's talk about something that's not promoting confidence. The debt ceiling debate down in Washington, D.C. People are already exhausted about it, and negotiations haven't really even started to get going. Now, Terry, you've got a different view on this. Can you just walk us through piece by piece? And we have time to do this. So just go through piece by piece why you think this can get addressed?
Well, first of all, we've had examples of a debt ceiling crisis in the past before, and they have found resolution. Now, I'm not going to say that this is the same, but I think the differences today are political. They're not really economic. Why do I say that? Because Kevin McCarthy wanted the acclamation of his party to become Speaker, and he had to make certain promises. And among the promises he made, given that this was January and we were already coming up against the debt ceiling, Janet Yellen had said so in January, one of the promises he made was that he wasn't going to back down with respect to getting out of the administration what he wants in terms of spending cuts if he's going to go with a debt ceiling increase. Unfortunately, he got the speakership, and now he painted himself in a corner because he made that promise to his caucus, and he can't really back out that easily. So now you have a hard stone coming up against a hard wall, et cetera. You've got two intransigent sides. I actually think that we might come down to the wire, and I actually think that the way we may resolve this is not through the traditional means of a debate and negotiation that results in a compromise. I think we may approach a crisis, but I think the cleaner solution here, if we don't get to a political resolution, is simply for the U.S. Treasury to continue to do what it's doing, i.e. issue debt, and get challenged in the courts by the opposition. Now, remember, they've already passed the spending, so there's some legal basis for the view that they have to issue the debt to support that spending because that was a bill that was passed. But what happens at that point? Well, I think it will go immediately to the Supreme Court. I think the Supreme Court could issue an injunction. I think the Supreme Court has legal basis for doing that. They have Amendment 14, Section 4 says the debt of the United States will not be questioned. And that's a legal basis for telling the administration, you can do what you want. And if that happens, by the way, it'll put the debt ceiling situation on ice forever because now you have a clear judicial ruling. So that's a clean way to do it. There are other.
Doesn't sound too clean. Let's just
look.
Way.
I mean, to come in here and have the Supreme Court, which is co-equal to the other two branches of government, and effectively say, no, this is our purview.
The outcome would be clean, sure. The process, not so
well,
much.
It can happen in the course of 48 hours. You don't really need, a lengthy hearings on the part of the Supreme Court. They have the Constitution right there. They can read what Amendment 14, Section 4 says. It's very clear to me. You should read it yourself. I mean, it's undeniable that this is not something that's constitutional to intentionally let the payments go unpaid. There's another way to do this, of course. The Treasury has hundreds of billions of gold in storage, right, at Fort Knox. One way to do this is simply to issue gold certificates to the Federal Reserve and have the Federal Reserve continue to fund the government's operations through this period. That's a solution. Look, there are a few workarounds. People have proposed these. You can go on the web and you can read them, and they happen to be cleaner than the messy situation we might get ourselves into in the next few weeks.
This is a dissertation, folks, on the history of debt coming out of World War II. Terry, how much of this is almost religious in nature? We have a culture in this America. I'm going to generalize it's Calvinist, but that's unfair to the gentleman from Switzerland. Debt is bad. And Heilbronner and Bernstein wrote a classic monograph on this 30 years ago. Debt is bad. We've got to get rid of debt. And then we don't, do we?
Right.
I mean, to me, there's a whole cultural overlay here that's unspoken.
Yeah. Debt in support of investment, debt in support of assets being created in the economy, debt in support of more productivity by way of that is good. Debt in support of more spending without a concomitant amount of savings on the other side is bad, especially when that debt rises to a point where the income that's generated by the spender is no longer sufficient to honor that debt, to support that debt, to support the obligations of that debt implied by that debt. So I think debt is perfectly fine. It's an aspect of the capitalist economy. With limits, right? It depends where it's going, what activities it's supporting effectively.
So let's get to the market question. Is there any risk? What is the risk outside of the so-called at-risk securities in the T-bill market? What is that risk? What does that look like?
Well, look, a lot of people say that if there's a missed payment on a principal payment or missed coupon payment, that Moody's will put the U.S. in default, or S&P will put the U.S. in default, and then that will trigger CDS payments on the swaps. I think that is not realistic, and I say that with reference to the fact that unlike a corporate bond or a corporate obligation, U.S. Treasuries don't have cross-default provisions. If I as the U.S. Treasury do not make a payment on a single bond, it does not accelerate the payments on every other obligation that the U.S. Treasury has. Yes, you can say maybe that bond has defaulted, but the corpus of debt has not defaulted. There are no cross-default provisions. And that's tricky because you have to think of a default as something different. And Moody's would have to think about it as something different than they would if the similar thing happened for a corporate issuer. And that's tricky. That calls for a judgment call at that point. And it's not too clear to me that even if a payment is skipped, that Moody's will go that far because it has that out. They can avoid calling a default. We could avoid going to triggering CDS.
What would that mean for things like collateral? Treasuries used as collateral for all types of things. What would that mean?
Well, look, the collateral, the value of the collateral is only as good as the price of the collateral. So to the extent that we're talking about a few pips change in the price of those treasuries, yeah, you'll demand more of them to support whatever repo activity or lending activity you're trying to sponsor. But in the final analysis, as long as the treasury bill has value in dollars, it'll serve as good collateral, right?
30 seconds. Martin's Place, Sydney, Australia, Macquarie Group. Do you still believe in the Pacific Rim expansion?
Oh, I don't necessarily believe in the China expansion. Long term and structurally, I mean, yes, China's undergoing a nice recovery these days. It's hindered somewhat by the slowdown in demand coming out of Europe and the U.S., but domestic demand in China is good, and that's enough to keep China's engine moving forward for another year. Beyond that, structurally speaking, you have a demographic problem in China. You have the demise of globalization. These are the things that are going to slow the Asia-Pacific story beyond this year.
Weak PMI early this week. Surprised to see it. Terry Weissman, thank you.
My pleasure,
Smart
Jonathan.
stuff at Macquarie. Smart stuff. We'll get you back to talk about the debt ceiling because that was actually an interesting conversation, Tom.
Yeah,
relative to the other conversations
you
about.
Talk with Terry, you get an interesting
the
conversation. With me, you get nothing. I understand.
Do you need some love?
No, well, I'm going to get it next from Aston Martin.
Very cool. Mike Crack coming up next. Aston Martin F1 team principal, and I promise you this time, he's coming up next from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. Now, it comes after the Treasury Department warned the nation risked default as early as June 1st. The White House has said it would not negotiate with Republicans over extending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that switching to a targeted coverage approach, where business accounts get more coverage than the current cap, would be the best option. That will require Congress to act. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Many of the cuts are expected to take place in the banking and trading group. BP is slowing the pace of share buybacks. The UK-based energy giant posted first quarter profit that beat estimates. But the surplus cash flow it uses to boost investor returns shrank by about 40%. BP says it will repurchase $1.75 billion of shares before announcing second quarter results. Now that's down by $1 billion from the previous period. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Fernando is a fantastic driver. He's one of the best of all time, and he's finally got himself in a competitive car. And at 41 years of age, he's giving all the 40-somethings something to root for. He's going to be a competitive driver and team this year for us, and we've got to very much keep an eye on them because I think they could be the dark horse of this championship.
Big time. Fantastic to catch up with Christian Horner, the Red Bull Racing team principal, speaking to us about a month or so ago on the threat posed by Aston Martin in Formula One this season. Tom, to see them second in the Constructors' World Championship in F1 has just been absolutely phenomenal. What a turnaround for that franchise.
And for those that are learning like I am after watching Netflix and America Climbs on Board this, John, what I find is so important here is how small the group is. There's 20 drivers, there's 10 teams, whatever. David Ricciardo at the Met Gala last night, because he's not the official driver for the Red Bull team. He was there as the backup driver for Red Bull.
Daniel.
Daniel, what do I know? Come on, Daniel Ricciardo. Mike's going to hang up. And the answer here is Aston Martin is on the up and up. That's my summary.
It's just great and wonderful to see Fernando Alonso doing what he's doing.
It is. And Alonso, of course, is picking up on this. This is some of the merchandising and imagery you see. We've got Alonso selling luggage while he's waiting to get a phone call from Taylor Swift. John mentioned that earlier. But Alonso's selling out the fancy Globetrotter luggage right now in London. Cool. And, this is sort of the up and up, the branding of this around you got to beat Red Bull.
Just amazing. Joining us now, I'm really pleased to say, is Mike Craig, the team principal for the Aston Martin F1 team. Mike, wonderful to have you with us on Bloomberg TV and Bloomberg Radio. I have to say, Mike, this wasn't what I was expecting last year when I heard the news that Sebastian Vettel was leaving and Fernando Alonso was stepping in. To see you second in the Constructors' Championship is quite something. Mike, what's led that turnaround for you and the team?
Well, to be honest with you, I did not expect that either, to make such a big step. But we tried to develop our car as much as we could last year. And during the year, we made substantial progress. But it was never enough to pick the big points and move forward in the championship. So, by the end of the year, the car was in a much, much better place and we were much more competitive. And we took another step over the winter. And because everything is relative in this sport, it could also be that some other competitors have not made the step that they wanted, and it brought us to the place we are in now. And we are quite happy to be there.
Mike, we'll get to the business of all of this in just a moment. Can you tell me how important it's been to bring Dan Fallows, the technical director, on board to Aston Martin F1?
Yeah, Dan is one of many recruits that we had lately, all across last year. And they have been very, very complementary to great workforce that we were already having. So all in all, I think they came together as a great group, get all the strength out of everybody. And you see the result on track finally.
I look, Mike, at the extraordinary original that each race is different. In American baseball, we compare Fenway to Chavez Ravine and other baseball parks. The distance from Baku to Miami in terms of the actual track is just extraordinary to me. How much is the adjustment for you in 10 days to go from Azerbaijan to Florida?
Well, it is first of all, it's a huge logistics effort to bring the whole circus over to the US, but in that short time, then you have to adjust basically everything, not only the clocks, but you have to bring the cars, adapt the cars to the layout of the Miami circuit because it's substantially different. And then we need to get used to the temperatures, to the heat, and all the things that are different. So it's quite a substantial exercise for everybody.
I look at Red Bull as a leading team now, and the two drivers really going at it second by second, tenth of a second by tenth of a second. And the relationship of your two drivers is absolutely extraordinary. The veteran Alonso with Stroll, and granted, I get the idea that Dad's helping out as well, but Stroll seems like he's really earned his stripes. Explain the relationship of your two drivers as they go into Miami.
Well, they are, first of all, they are great drivers, but then also they are great human beings, very mature and great teammates. And they help us big time to work as a team much more than other teams do. Very often, and you see it with other teams, there is a fierce rivalry between teams and teammates, which at times is even ending in accidents at the circuit between these two cars. I think we are fortunate to have two such great drivers that have understood that this is a team sport and that the rivals are out there with the different colored cars than ours, and we need together at every possible opportunity to do better than the others.
Mike, I have to be honest with you, and this is my perspective. The Miami racetrack looks absolutely terrible. And Mike, I've got to say, and maybe you've got to be more diplomatic because of the position you're in, I think there's a worry for long-term fans of this sport that the emphasis is on breaking the United States of America and they're willing to sacrifice the quality of the racing to do so. Mike, do you share those concerns?
No, I do not share these concerns because I think the racetrack in Miami has everything that is that a normal modern Formula One racetrack has to have. It has straights with DRS zones. It has high-speed corners. It has some low-speed corners. It has been completely resurfaced, and I think the heat that we will have over the weekend will add a lot of difficulty to cool the cars, but mainly to also keep the tire management under control. So all in all, I think we are up for a great weekend with great racing.
Well, clearly the future's bright for the sport. The attention it's got off the back of the Netflix series has just been absolutely phenomenal. To get my partner in crime, Tom Keene, on board to focus on F1 has been a pleasure for me over the last 12 months or so. Mike, I want to talk about things further down the road. There's always been a relationship between the F1 team and the road car. Ferrari's a great example of that over the years. More recently, Aston Martin again, talking about the same thing. I want to understand the tension 10 years out. When Aston Martin and the road car is fully electrified by 2030, say, where does that leave Aston Martin F1 and the relationship between the F1 team and what goes into the road car?
Well, that is a very good question, and the same applies also to all the other brands, the one that you were just mentioning. I think F1 is currently working heavily into carbon net zero, into going more sustainable by 2030, which is much less than in 10 years' time. So by 2026, we will run only on sustainable fuel. We will substantially increase the amount of electric power that we will deliver to the car. It will be around 50-50. So the Formula One cars are already hybrids, but the electric part will increase, and it will complement the road car fleet by these developments.
How will that take place if you're going to retain to some degree the internal combustion engine and the road car won't?
Well, I think lately the developments in artificial or how you call them, sustainable fuels is adding or is massively increasing life of the combustion engine, and it has been also classified like that. So from that point of view, I think Formula One can be a great participant or a great catalyst to the road car business to make these nice cars that we have today sustainable and be able to run them for longer.
I sense from what you're saying, Mike, that you don't think F1 ever becomes fully electrified. And actually, to some degree, you can go some way to preserving the internal combustion engine on the road. Is that right?
Well, that's a good question. I think the combustion engine will have its time for the next 10 years for sure. But ultimately, it will fade out, and Formula One will not be with a combustion engine in say 20 years from now. I would doubt that.
Right. Mike, our reporters in London, they're like, okay, enough talk about Taylor Swift and the rest of it. What's the relationship with Honda going to be out to 2026? Are we going to see some drama as Honda tries to climb into Formula F1?
We are quite happy with the powertrain, power unit manufacturer that we have at the moment. We have a lot on our plate at the moment for 2023, 2024 to make further progress. And we are not really too much into 2026 at this stage.
Mike, just for the pit passes for Miami, 731 Lexington Avenue. Have you got the zip code?
Yeah.
Have you got the zip code for Mike?
10022.
Okay.
Tell Alonso I'll buy the Globetrotter luggage if you can get us into the pits.
Mike, thanks for this. I appreciate it, mate.
We could be there with Taylor.
Good luck for the weekend. We're not going to ask about Taylor.
No, we're not going to ask about
Mike
Taylor.
Craig.
Thank you very much.
Of Aston Martin
Mike,
F1. Mike, thank you. What a pleasure. Looking forward to the race this weekend.
This is fun.
It's a good time, right?
You got a lot of
Very
emails,
cool.
and people worldwide are just geared up for this thing.
Back to markets in the next hour.
Yes.
Anne Milletti of Allspring Global Investments. That conversation just around the corner. Your equity market negative 0.15%. From New York, this is Bloomberg.
I don't think the economy is that bad. I think it's very specific portions of the market, which have problems.
I do think that the Fed is likely to go ahead and hike later this week.
The Fed should have paused a while ago. The Fed will be cutting and should be cutting.
The risk is greater that they move too far, too fast, as they have.
The hope is that if there is a downturn, it'll be short and shallow, but no guarantees in that regard.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Welcome on radio and television. And a most interesting set of days ahead. Apple earnings out there, and before that, a Fed meeting tomorrow. Today, is there a bank reorg today, John? There's not another bank to go
Well, there's some
down
job
today.
cuts. Morgan Stanley planning 3,000 more of them to go. Clearly, investment banking's tough. Deal making's difficult. We can see that.
Let's do that there. And to me, John, and frankly, this is going to go to the right sizing of First Republic like JPMorgan, is you right size. And the solution is in financial difficulties is you cut costs. And so there we are.
We've seen a lot of it. So let's talk about the difficulty right now for people trying to make a call on this Fed. I've seen so many headlines like that one. 3,000, Morgan Stanley, tens of thousands, pick a tech firm and put a number on at the end of it. What you haven't seen is that show up in the headline data in a major way.
Yeah.
So I've taken a first look at payrolls, which come out on Friday. Here's the median estimate in our survey so far, 180,000. Down a bit from 236, but 180, Tom, with unemployment in and around 3.5%. Still looks like a pretty decent jobs market,
I'm going
doesn't
to
it?
look at a 3-month moving average on that, and the answer is it's still way above. And what's interesting is the economists that calculate the optimal non-farm payrolls, it's a shockingly low number. It used to be 150, and it's come down over the years. Some people are even under 100,000. So they look at NFP or some of the other data, and they just say this is a boom labor economy.
So the Fed's committed to 25. What will they commit to next? Overwhelmingly, the consensus view is they won't commit to anything. It'll be a conditional pause. My question would be, okay, if they communicate a so-called conditional pause, is the bar higher for a cut or another hike? Which one?
You and Bramo can dive into this all you want. I'm just going to go with the economic data. And frankly, there's a lot of economic data, including today. I mean, I don't think we can make light of, is it the frontline data? No. Durable goods, JOLTS survey today. I mean, they matter to this debate. And, again, John, ISM, you believe in, May 3rd here, ISM coming up by ISM Services.
ISM manufacturing rocked this market yesterday.
Yeah.
Prices paid rebounding, shooting yields higher. Saw the same thing off the back of the Meta bond issuance. Had a lot of bond issuance yesterday from the corporate side of things, really pushing yields higher across the curve yesterday, Tom.
I predicted it, and I've also said you're going to see a great zombie roll-up, 4.14% to get our 2-year yield going.
Let's get you through the week. Federal Reserve tomorrow, ECB Thursday, payrolls Friday, Apple earnings after the close on Thursday. Going into all of that, equity futures right now, negative 0.2% on the S&P 500. Equity's just a bit softer here. Yields just a little bit lower, down 3 basis points. The 10-year still in and around 350, as it has been for the last several weeks or so. And to look at the euro, still sub 110, 109.67. I make that 1, 2, 3, I think 4 days of weakness now on the euro side of things against the dollar, Tom. Just backing away a little bit from the year-to-date intraday highs that we printed just last week.
And quickly and distant, the yen backs away. We talked to Elsa Lignos about that, and I'm sorry, I'm always bringing yen dynamics into a global and indeed an American analysis, and you're really beginning to see some standard deviation jumps here of weaker yen, and I just would suggest don't ignore that.
You know what's not weak? The Aussie. Aussie is
They're
strong
proactive.
This morning off the back of a surprise 25 basis point hike, some indication they might go again.
Right.
And clearly some indication also that they're willing to tolerate some growth weakness to get inflation down.
Thierry Weissman of Macquarie Group, Sydney, Australia, making clear, at least in the short term, China's got some oomph there as well. This is a joy this morning to drive a conversation forward. And if you are institutional or retail Wall Street and you are looking at your value portfolio underperforming, this is the conversation of the day. No question about that. Amoletti is iconic. It's strong of Milwaukee. It is part of Allspring Global Investments, and she's head of active equity right now. State the value case over the growthiness of big tech.
Well, Tom, I do think that, values had a little bit of a run last year, and you saw the reemergence of growth this year. Not surprising, right? Because you saw interest rate contraction a little bit, and that multiple contraction you saw in growth stocks reemerged this year and gave some of that back. Plus, fundamentals of those big tech names looked better than people expected. And so you saw those big tech names do better. However, valuation of those big tech names now is a little frothy. And I think the risk reward is not as favorable as it looked in the beginning of the year.
Your claim, good or bad, is to find the value trap and ignore it. Where is the value trap right now?
I think the value trap in the market right now is low quality. It is not paying attention to fundamentals and just throwing darts, owning everything. That's a value trap today. You cannot own an index in an environment where rates are going up, inflation is still high, and the economy is clearly weakening. Now is the time where you really have to be selective.
Crisis. Mohamed Al-Iran came on this program several Fridays ago. I think we're at the IMF World Bank Spring meetings in Washington. He said this is not a banking crisis. You say it is. Why is this a regional banking crisis?
I don't think we haven't seen the end yet. I don't believe we have. And look, I heard other people on your show this morning say it is. Things typically don't end as quietly as they have. You don't see a big fraud like FTX. You don't see regional banking crises as 3 banks collapse and then just everything settle out. There's too much noise. There's going to be something else. Is it going to be another regional bank, or is it going to be something else? That I don't know for sure, but we do know, commercial real estate, specifically office real estate, is held by a lot of regional banks, and that is problematic. But again, I do think there's been so much noise in that, or so much talk in that space, that's been pretty well telegraphed, or the worst kept secret maybe. I really fear more about what others aren't talking about, maybe even what I don't know. I should be worried about today. There's likely to be another surprise out there.
So I'm going to take all my money, put it in a money market fund and pick up 4% plus maybe and hide. I imagine that's not what you're advocating investors should be doing. So what are you telling them? Yeah,
that old adage of sell in May and go away, not a big believer in. And here's why, Jonathan. I don't have that crystal ball. I don't think anyone coming into your studio has the crystal ball of really knowing what's going to happen.
Some are good at pretending.
Yeah, some are. But the reality is if you sell today, you have to be good at 2 things. You have to be good at timing on the way out, and you have to be good at timing on the way in. That's not what I've been good at my whole career. I think that's not what I'm paid to do. That's not what good investors do. What good investors do is select the right companies and stay invested in those companies throughout the cycle. And I think history has shown you get rewarded for doing that.
On an active basis, which you've led in, and you had a great year last year, and 3 years, 5 years is really challenging to say the least. On an active basis, do you have to hold fewer holdings now? Do you have to tilt towards Sequoia, acclaimed Fidelity 50, Joe Mircino at Fidelity 50 years ago, and what you did at Strong? Do you have to hold fewer items now?
I do think you want to be I do think you own fewer names. I don't think you want to be so concentrated that you bring a lot of risk to the table. So, what is the right number of names? Is it 50? Is it 100? It's
well, your top 10 holdings on large cap is 44%.
Yeah.
Is in the top 10.
I mean, in large cap, I think you have to be a little bit careful, because if you look at the indexes, the indexes carry so much weight in the top 10, right? And the indexes are the enemy. And so you have to be, competing with the enemy for large cap. But if you look at, the mid cap, the small cap space, 75 to 120 names, maybe that's kind of the better average to think about. Large cap, you can be a little bit more narrow than that. But you still need to be diversified in the number of names you own in a portfolio. As an investor, you want to be diversified across what you own. And maybe we should talk about some of the things that I do like in the equity space.
I've tried.
Yeah.
What do you like?
I know, it's hard.
Typical Milady taking over the interview.
Sorry.
What do you like?
It is hard. I know I've been pretty pessimistic. I do think there are some spaces. Healthcare is an area that has underperformed, and it has been an area that really hasn't recovered that well post-COVID. It's held back, but there's a lot of room in the med tech space, in the healthcare services space, and the multiples really haven't recovered there. So, Tom, if you want to talk value, right, there's some value there and some good long-term growth potential. I do think emerging markets also look quite interesting. And there are some emerging markets where, rates rocketed it much higher than they did in the U.S. And they're on the other side. They're starting to come down. And so they're ahead of where we are in this cycle. And the dollar's also starting to show some weakness. We all know that if you look at the dollar versus emerging markets, when the dollar weakens, that's typically good for emerging markets. And so that could be an interesting area for investors.
Some of those countries were the true front loaders. Do you want to talk F1? Do you want to talk Formula One?
Well, you guys are the experts, clearly.
Hey.
Oh, yeah, you're not looking at me.
You've been really fast and loose now with experts.
It was great.
And thank you.
Yes, thank you so much.
Thank you. Anne Milady there of Allspring Global Investments.
I can see her
You're an
in
expert
Vegas.
now.
I can see her, you
want to go to Miami or Vegas?
No, she's like you. She thinks Miami's sort of like, no, that's not classic.
I just think
you go to Vegas.
There's a risk they...
What's a ticket in Vegas? I mean, Milady's
thousands.
got to be in the pit. It's got to be 10 grand just to stand there.
I've said this. I said this last time when we caught up with Kristen Horner of Red Bull. Sometimes you'd probably be better off flying to Europe and buying a race ticket to one of the tracks there
do that.
than trying to go to Miami or
Monaco?
Vegas.
You and me in Monaco with Bramo?
Pretty pricey. I'm thinking more Silverstone.
Okay, that's like in England, right?
We're flying to London and we'll go up north, Tom. Except it's not really that far north.
It's just outside the Watford Gap.
Something like that, yeah.
Nailed it.
Henry Trays of Vader Partners joining us shortly on the debt limit in Washington. And thank you. It's good to see you. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has set a high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. That includes 20,000 dead. The commander of Ukraine's ground forces says they have pushed back Russian troops from some positions in Bakhmut. Pfizer beat first quarter estimates thanks to persistent demand for its pandemic products. Still, the drug maker's COVID vaccine and antiviral face pressure at a time when infections are waning. Those two transformed Pfizer, contributing more than half of the company's $100 billion in revenue last year. But sales of the vaccine fell 77% in the first quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Had examples of a debt ceiling crisis in the past before, and they have found resolution. I actually think that we might come down to the wire. I think we may approach a crisis, but I think the cleaner solution here, if we don't get to a political resolution, is simply for the U.S. Treasury to continue to do what it's doing, i.e. issue debt.
A different perspective there from Terry Wiseman, the global currency and interest rate strategist over at Macquarie, a little bit early this morning on the debt ceiling debate, following the wake-up call from Janet Yellen, the Treasury Secretary, just yesterday, writing in a letter to congressional leadership the following: our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June, potentially as early as June 1. We now know there will be a scheduled meeting on May 9th between congressional leaders and the President of the United States. The President orchestrating that meeting just yesterday, May 9th, a week from today. Before we get there, got a Federal Reserve decision tomorrow. The two-day meeting begins today. We've got payrolls on Friday. I offered the estimate on payrolls for you a little bit earlier. If you'd like that again, it looks a little something like this, Tom. Close to, but just below 200K seems to be the estimate at the moment going into Friday.
And what are the revisions? I mean, I can't remember. I believe 3 months moving average is 1 million jobs were formed over 90 days, 333,000, whatever the number is. Yes, we're coming down, but do we really believe in a collapse in the job market in America? To me, I don't hear that many people saying that.
180,000 does not scream collapse in the labour market. Jobless claims at 240 does not scream collapse in the labour market, and 240 is the estimate for Thursday morning for jobless claims, just up from 230.
We haven't talked about it on a Tuesday, but I'm more interested in the real estate market, the commercial real estate market. I think a number of smart people have said, this is something that bears immediate scrutiny into the summer.
I agree. Take a look at the KRE, Tom. Regional banking ETF. Have a look at what it did yesterday. Yesterday, down by 2.8%. Even with
JPMorgan
precisely,
lifting, even
precisely. They can't get a lift.
Some terrific work again today. I really want to convey to you with Bloomberg Opinion. Matt Levine and John Authors, absolutely brilliant on JPM FRC. Look for that today. Henrietta Trey is now with us, Economic Policy Research Director, Veda Partners, with great experience on the marble halls of Capitol Hill. When there is a debt crisis, when there is some form of shutdown or jawboning, how does the budget process change on Capitol Hill?
I think, if anything, it speeds up. It speeds up dramatically. There was a lot of hay made about Secretary Yellen moving the date for the debt ceiling up from June 5th to as early as June 1st yesterday. But the reality is that nobody does anything until the last minute anyway.
Right.
We've got about 4 weeks to get this resolved. If those 4 weeks are in May or June or July or even September, it's not like they're going to start working in advance. I think Speaker McCarthy demonstrated a lot of goodwill by putting that vote on the floor last week, getting things moving well ahead of schedule, even before Secretary Yellen provided the update post-tax receipts. So basically, it just spurs them into action. We've got 4 weeks to get this resolved. That's plenty of time. We've seen it done in far less. And in fact, I would wager that it won't even start to come to an end until the week of the 22nd.
So based on that answer, 5 guys sitting on a couch with Chair Yellen in the Oval Office on May 9th doesn't have an urgency to it? Is that what I hear?
I'm happy for the Big Four to get in a room. I think that's very important. That is one of the steps in the process. But we have a number of other formalities that also need to be accomplished. Senator Schumer, the majority leader, has scheduled 2 votes in the Senate, or queued them up at least. One on a clean debt ceiling hike, with all the Democrats will vote for, and then one on the House passed bill, which some of the Republicans might vote for. So we're still at least a week away from any concrete negotiations. I want to see some of the budget committee chairs get called up. I imagine that there will be more than just this one group of Big Four that gets called up to the White House. And then, of course, we really want to see staff in the room. You guys know this about me, and so do all of our clients. I really care what staff has to say more than anything else. So I want to see those guys get together, and I would imagine that starts soon, and they're able to cobble together a deal within the next 3 weeks.
Let's tease that out a little bit more. Henrietta, I don't have a read on this. I've got no idea which way it goes. I'm told by some people it's the same movie, same ending, won't be any different this time around. I'm told by other people it is different this time. Henrietta, what informs your read on that? You mentioned staff. Walk me through it.
Right. Well, not only have we seen this movie so many times before, but it's almost an exact repeat of 2011. You can even find similar votes from 2014 and 2017. We have the exact same dynamic where the president is a Democrat, the Senate is controlled by Democrats, and the House is controlled by Republicans. What ends up happening is you see a bill passed in the House that's written mostly with the intention of just getting the majority party in one chamber signed on. That's what they did last week. And now we're going to start moving into the place where staff goes through the fine print and finds $300 to $500 billion in deficit reduction, which is the level that staff advises me on the Democratic side they're willing to swallow in order to hike the debt ceiling to $33 trillion, which would get us roughly through, call it March of 2025, after the presidential election cycle. Those are the kind of minutia points that staff is focused on. And you see those cuts come from things like clawing back COVID relief, reducing service on the debt, fraud, waste, and abuse spending. All things that were incorporated as a part of the Republican passed bill, but not nearly the $3 trillion plus number that Speaker McCarthy put on the floor. That's a non-starter. We need to get that down to 300 to 500 billion and horse trade back and forth. And that's what staff will do behind the scenes.
There's going to be a lot of ink wasted on a lot of analysis between now and then. Henrietta, indulge me and go through this scenario. This is something Terry Wiseman of Macquarie mentioned in the last hour. He said this, and this is a quote from him. If we approach a crisis, I think the cleanest solution here, if we don't get to a political solution, is simply for the US Treasury to continue to do what it's doing, i.e. issue debt. Henrietta, he made the point that they can just go on, ignore the political situation and carry on issuing debt and pay their bills. Is that something that you can see as a workable solution to this?
No, no offense, but it's just not. Congress is going to insist on acting here. I know it looks like they don't want to take a vote, but they react very poorly when any federal agency or otherwise takes some of their authority away. That jurisdictional control is something that you see committees covet, and certainly the House and Senate look no further than Ways and Means for their tax policy bills, getting blue slipped, insisting that they start in the House. They react very poorly when any federal regulator oversteps their bounds and usurps their authority. So I believe Congress will act. I am not concerned about whether they will act. Default is not an option. I think investors should, sort of skip over the headlines and see that Kevin McCarthy put that bill on the floor well before he needed to. We've got 4 weeks to negotiate. I see no real problem here.
4 weeks is enough, as far as you're concerned.
More than enough.
Henrietta Trace of Vader Partners. Constructive view on things working out in Washington.
And what's great about that, and it's sort of like the Dr. Weissman's expertise and the economics of it, is she's just in the trenches experience. It's like actually talking to people that have been through this before. How quaint.
We're going to talk to some people who've been through this before in the next hour on Bloomberg TV. Megan Swiber of Bank of American Securities. Tony Rodriguez of Nuveen. Daryl Cronk of Wells Fargo. We've been having so much fun, Tom.
Yeah, I know.
Time's almost up, yeah.
I mean, we can, do more Formula One talk.
What would you like to say about F1?
Out on Twitter, Autosport, with a really important thing is they went into turn 1 at Baku, and I remember when Verstappen passed the Ferrari guy, he was flying. And they just quantified it. He was going 30 kilometers per hour faster.
So one thing that we didn't get to...
I was stunned.
With Mike Crack of Aston Martin, that DRS thing is a cheat mode down the straight in Baku. I think it's...
Explain what DRS is to those ignorant.
Rear wing opens up, less drag, go faster down the straight.
It's like a turbo thing.
It makes the cars go faster.
Okay, I'm trying,
Let's put it that
Stay
way.
with me.
Makes the cars go faster.
Yeah.
And on a Red Bull, it means the car is going much, much faster.
You could see
down the straight.
the difference in speed.
It's like being on a computer game and hitting a cheat button and watching the car go that much quicker.
And in Miami, I would assume it's a bigger deal even.
It's meant to make the racing more exciting, to increase the amount of takeovers we see, but ultimately, I don't see much driver skill in that, do you?
No, I don't, but would you get rid of it?
At all. I don't know what the solution is, but I think it's become a little bit more of a problem at some tracks.
They're good. Thank you for your response
They need to reduce the window
this.
for it or something like that. I think they tried that in Baku, but maybe they need to do it.
That's great. Amoletti's into it. Anna Hahn loves it.
We're kind of thinking out loud about stuff we don't know about.
Yeah,
that's the show,
well,
right?
That's how we invented this, folks.
From New York, this is Bloomberg.
Bloomberg Surveillance on radio and television. Thank you for joining. Lisa Abramowicz is off today, still recovering from the White House Correspondents' Dinner. And John Farrell preparing for the 9 o'clock hour of an eventful Tuesday into the rest of the week. We're going to get briefed by Claudia Sahm, one of our most popular guests here. She's got some real belief on what the Fed will not do into this year, in the following meetings into 2024. But right now, Michael McKee with us, and we pause because McKee doesn't have to look down at his computer screen and digest 12 pages of material in 32 seconds. It's a pause here. And let's start, Mike, with at 10 a.m. this morning. You lectured me once, hey, stupid, pay attention to the JOLT survey. What does the JOLT survey tell Jerome Powell this morning at 10 a.m.?
I was just delivering the message from Jerome Powell to you. The JOLT survey is kind of what they hung the idea of tight labor market on. The number of job openings was so great by a magnitude of factor that it had to indicate that there was a shortage of workers, and that was leading employers to bid up their pay in order to get them to come back to work. And so a drop in JOLTS, which we did see in the last prior month that was reported on it, is considered good news. So we're looking for a bit of a drop today in terms of numbers. Now, I have to also caution that the JOLTS report is not seen as widely accurate, that there may be a lot of duplication in it. There's a very low response rate from companies to this,
right.
But it's one of those things that we have it, so people look at it.
Let's go to the Fed meeting. Tomorrow you will be there. You will be asking questions. Always, Mike McKee is down later. We were making a joke earlier in the show that Colby Smith of the FT will probably get the first question. And then the chairman will read whatever the rude question is off of a prepared statement. Who makes that statement for him? Is he there writing it with a kid at his desk with his Bloombergs in front of him?
He is working with the staff there to anticipate the questions we might ask.
Which is the question that matters now written out?
Well, there's a couple of them. The biggest question is going to be how they sell the idea of staying at 5.25% for a lengthy period of time. Will there be any kind of circumstances under which they would think about cutting rates, because that's what the market thinks they're going to do? And if the market thinks that, does that mean that the Fed has a problem with A, credibility, and B, financial conditions?
Have we ever been here? Have all the other chairmen of our youth and onto our middle age, have they had to define pause dynamics before?
They have. It has always been a question that comes up when they get to the end of a tightening cycle. And generally, it's going to be interesting to see the statement, because generally they don't say it's the end of a tightening cycle. They say, we think we are close, and we might have to do some more, but that'll depend on incoming data. And I suspect you'll get the same thing again in case we see some inflation data pop up.
The inflation data, I mean, that's the issue at hand right now. Where is the inflation rate in Jerome Powell's head? Which is the statistic, and what is that level of inflation he's looking at right now?
Well, they're still looking at over 4% on the PCE, which is the target they choose, the index that they choose to do their targeting. Their feeling is they're going to get down into 3 to 3.5 by the end of the year, when rent start to show the decline that have been priced in advance. Because of the statistical way they collect all this, it's been a slow process to get rents down. But you should be able to take a good portion of it out.
Right. That's good, Mike. There's some Boston Bruins swag. It's on sale today if you're looking for that on your trip down to Washington.
I got a note from my brother yesterday that said it was perhaps the worst defeat in hockey history. So
yes, I would. I think it's a big shock, to say the least.
I would point out that the Red Sox are not in last place, so this is good news.
Things can move forward. Michael McKee, thank you so much. And, of course, anticipated our Fed coverage tomorrow, including Michael McKee in Washington with the chairman. Right now, and this is really important, a conversation with Claudia Sahm, who was on fire yesterday on Twitter. She's a former Fed economist out of Michigan, Sahm Consulting, and also, of course, writing occasionally for Bloomberg Opinion when she chooses to. Claudia, I'm going to cut to the chase. You are pivotless. This is not a Fed that will pivot. Why is that? Why will the Fed just say no?
Well, there's a lot of reasons why, as we go later into the year, the Fed will not cut. They will not cut if there is a recession. They will not cut if there is banking turmoil or financial market turmoil. I mean, we've seen this twice. They're going to hike tomorrow, and that'll be twice after bank failures. And the lesson from the past is that if you go back to the Arthur Burns, who is widely viewed within the Fed as the worst central banker in the history of the Fed, he kept cutting when unemployment went up. And that led to Volcker having to stay the course in a severe recession. This Fed does not want that. That's not how they're going to justify it. They're going to talk about the natural rate, R star, all that good stuff. But the history looms large in the Fed, and it kind of makes sense, too.
Within that, they have time, and there's a sequence of meetings out every 6 weeks or so. I would suggest they have massive asymmetric advantage to waiting and seeing more data. Is that how you read it?
They may have an advantage. I'm not sure all of us do. right? The Federal Reserve has become data dependent in almost a backward looking way. They know full well that inflation takes time to come down. There is a lot in the pipeline. If they don't start looking forward with their decisions, it's going to be too much. That might not show up this year, but they're playing with fire here in terms of pushing when we already have a lot in the pipeline.
I want to go to your Michigan economics, and one of the ideas, the soul, if you will, Ned Gramlich and all of Michigan economics, is the partitions of American society. What percentage of America right now is in recession?
Well, this is a really interesting point. When we're going to get the data on Friday for, say, the labor market or the JOLTS today, these are national data. They mask a lot of what's going on under the hood, both in terms of individuals and groups of individuals, also parts of the country. There's over 40% of the states in the United States that haven't made a full recovery in employment. We don't talk about that. So there are a lot of differences in terms of where the recovery is and in terms of where a recession would hit hardest.
And I would suggest, I don't want to get into a stagflation discussion. I'll let David Weston do that with Professor Summers. But the idea, Claudia, of celebrating 1% GDP, that just doesn't get it done, I would suggest, for half of America. Am I right on that?
I think you're right. GDP is a pretty abstract concept. I still look most of the unemployment rate into jobs. That's what means the most to Americans. And it's low, right? And remember that 1% GDP, a lot of that is inventories. We see consumers still spending. That's
right.
What we want to see, is people being able to get what they need.
Well, let's go, Claudia Sahm, to the job economy then. And to me, what is so important here is a decile make of it. We all know the charts that show the bottom decile, the bottom quintile has really been doing well. What about the broad middle class and the COVID recovery?
We're doing well. I mean, this has been a bottom-up recovery. That owes to a lot of things. And above all, right now, a very strong labor market. The top of the top, their income, their wealth is not as dependent on jobs as basically everybody else. And so we've seen a lot of progress. Unfortunately, inflation has eaten away at that. And yet there is progress in jobs, and it is true. We have done a lot to close some of the gaps at the bottom, and that is truly something to celebrate and to keep, to really try to protect.
Neil Dutta of Renaissance sent me a blistering note yesterday underscoring his optimism on the consumer, his optimism on good incomes, if not great incomes as well. Is there a great misjudgment? I mean, beginning with the IMF, but is there a great misjudgment about the resiliency of the American economy here?
Yeah, so I have full faith in the American consumer and American workers. Like, they'll put it in and be able to spend. I mean, people need a lot of the spending by Americans are items and services that they need. So if they got the income, they'll spend it. Where I have maybe less full faith is in what's happening in Congress and at the Federal Reserve. Anything that looks like a debt ceiling debacle or federal debt default, that would just be disastrous, and we don't need that right now.
Okay, I get that. And John and I have been going back and forth on this, and I'm old school on it, folks. It's going to get solved. Are you telling me they're not capable of moving the can down the road?
I'm not sure they take it seriously enough. I mean, honestly, what was put through the House by Republicans, that's not a serious start. And we have a month. Your prior guest gave me quite a bit of hope. I haven't worked inside the halls of Congress, and yet this is not the time to be playing with fire. And the economy, while I agree with Neil, there's a lot that's good in what's happening right now, and I think there's probably too much pessimism. We are in a fragile place. That's a lot to withstand.
Well, I'm looking at short-term rates, and maybe it's outside your purview, but I'm going to go there right now because I got to get one more question in here. And the fact is, old school 3-month LIBOR just climbs and climbs and climbs up as well, including more recent 3-month or even inside 3-month measurements as well. How do you, as an economist, interpret the stunning rise in short-term yield?
Again, I think that fits with this degree of pessimism. I mean, I have a hard time like, again, what markets are predicting, which is reflected in the prices, I have a hard time squaring. I very much disagree, as we talked about before, that the Federal Reserve is going to start cutting later in the year. I think we could have a recession. I think that, I agree with that, but I think there's way more pessimism in place. So things are, and a lot of that then is in their views about the debt ceiling, and there's just a lot going on. So frankly, I think it's harder than usual to parse out what markets are doing.
Dr. Sam, thank you so much. Claudia Sam with us with Sam Consulting, writing for Bloomberg Opinion and far more. I mean, she came out of school and she has her own ratio, her own index statistic with the Federal Reserve Bank of St. Louis, keeping score on the SAM index having to do with our labor dynamics. Let me give you a data check here, and I'm going to call it odd here, because after what we've seen with JPMorgan and First Republic Bank, we got to get back to the correlative forces out there. I think John's right, 4.13% on the 2-year yield, elevated over the last number of weeks, not with a breakout yet. 60 basis points of curve inversion. The real yield gets noticed, 1.31% on the 10-year real yield. Futures -8, Dow futures -85, and the VIX still remarkably solid, not 15, but a 16.60 on the VIX is of note as well. Hey, Bitcoin, 28,000. Stay with us on radio and television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. It comes after the Treasury Department warned the nation risked default as early as June 1st. The White House said it would not negotiate with Republicans overextending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that switching to a targeted coverage approach, where business accounts get more coverage than the current cap, would be the best option. That will require Congress to act. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Now, many of the cuts are expected to take place in the banking and the trading group. Shares of Chegg are plunging. The company warned that the ChatGPT tool is threatening growth of its homework help services. Now, Chegg makes much of its money in subscriptions, and that's a revenue source that's in jeopardy if students see AI chatbots as an alternative to paying. And the one-time high-flying Vice Media is preparing to file for bankruptcy. Bloomberg's learned that the online media company has been looking for a buyer. Well, now it's preparing for a possible bankruptcy filing in coming weeks. Now, Vice was once valued at $5.7 billion, and its investors included Disney and Fox. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This Fed raised rates much more than the forward guidance suggested. They put those rates way above where the market suggested last summer they were supposed to be, based on the inversion of the yield curve. In the banking system, the lending system doesn't work when you have a higher short rate versus the longer rate. Yield curve, not just as a predictor of recession, but causes recessions.
Joe Lavorgna, SMBC Group chief economist there, and he's been very dead on about the excesses of the Fed. That's been part of the debate. He's clearly been one of the crew looking for excesses there. And certainly we see within the debate this morning, going to tomorrow's coverage, words will be carefully chosen by the chairman of the Fed. We'll have complete coverage for you on that tomorrow. Futures -8, Dow futures at -81. I'm going to call it a churn to the market, but I really want to point out that within this, the banking stocks need a recalibration today. I'm going to sell this to you as clearly as I can. Matthew Levine and John Authors of Bloomberg have written two brilliant essays, very different essays, but two brilliant essays of the historic moment. I don't think enough has been made of the second largest collapse of banking in our recent history. And Levine and authors absolutely kill it for Bloomberg Opinion this morning. That's required reading for Global Wall Street. Always a study for Global Wall Street is Christopher Verone, partner, head of technical and macro strategy at Strategas. It is a Baird company, and where Chris and I are in common ground is a beloved belief in the trend now. And as you said, Chris, as we were talking here before this moment, you're in search of trending. Trending's out there right now, and the cacophony is so great right now, there really isn't a trending to trend on.
Yeah, there's not much. I mean, when you look at the external trend of the market, I guess you could say generously it's up. But when you look under the surface, it's a mess. I mean, you only have 50% of the S&P above the 200-day moving average. Right. So you go sector by sector, group by group. There are names that you would expect to be behaving in a very similar way are acting remarkably disparate relative to each other.
Why is that?
When I think about what our estimates are for growth, both nominal and real, I don't think there's enough real growth for everything to work. I mean, good, durable, advancing bull markets, you'll get 80, 90% of issues involved. I mean, we're dealing with half the market on the field and half the market off the field. I think there's really no better evidence of that than a sector like discretionary, where it's about as split as I've ever seen in 10, 15, 20 years. You have things like autos very weak, yet home building very strong. You have retail awful, restaurants good. Very, very split.
On a log chart where you're looking at percent change, when you look at the big tech stocks that have outperformed, do they have technical veracity right now, or you just can't make a call?
I think they have veracity, but even tech, which I think is being confused as a very strong sector here, when you look under the surface of tech, it has the same problems that the broader market has.
It's got 7 stocks moving and everything else is not there.
In fact, under the surface, it's actually worse than the broader market. I think on balance, Tom, when you look at like yesterday's new low list, regionals, big banks, consumer finance, retail, metals and mining, steel, I mean, that's the handbook of what you don't want to own into a slowdown.
The heart of the matter here, folks, and this goes back to, we all read John Maggie, written in the 1940s. Chris Verone and I got out to maybe the 6th edition. And, you know, I think of the Chartcraft people up in Larchmont and all. Those were normal times where you looked at 100, 200 stocks. Nobody's looking at 100 or 200 stocks right now, are they? I mean, it's basically been blown up.
Yeah, I think it's certainly been blown up, and the concentration of the market, particularly at the top, whether it's passive or whether it's ETF, certainly contributes to that. But let's go back to basics. Does the leadership of the market here look like economic growth is about to reaccelerate, or does it look like it's about to slow down? I would choose the latter here when you see the weakness in banks in particular, the weakness in autos, the weakness in steel.
Jane Fraser at the Milken Institute with Bloomberg made real clear, and granted, she's a public voice. She's got to say the right things. We all get that. It's like Jason Trennert is the same way. I mean, the guy's so large, he has to say the right things. So Jane's given the line, it's over, FRC is done. Thank you, Jamie, for taking him out. Baloney says a large body of people. What do your charts say about the recoverability of the different shades of regional banking?
Well, how about what the market says? Why can't the stocks rally? Where 5-6 weeks past the acute phase of this crisis, where 48 hours past the news of JPM and First Republic, and look what led on the downside yesterday. The regional banks were terrible. You have all of these either at or making new lows right now. So we asked the simple question, as we did in our work this morning, if the crisis is over, why can't the bank stocks rally? And it's not just the small communities and the regionals. Bank of America hasn't rallied here. PNC hasn't rallied here. KeyCorp hasn't rallied here.
Right.
It's a mess.
Okay, I'm going to give you a window, folks. We're going to go adult pro tech talk here. We can do that with Christopher Verone. And radio charts always work, so it really works out. I'm looking at the Keefe, Bruyette & Woods Bank Index, and I'm looking at a Wells Wilder 5-trend series of parabolic SAR, Kleiman exponential moving averages, and critically ADX DMI, which is a measurement of trend. I can't own this. What do you need to see where you can say I can buy the banks?
Well, I think at a minimum here, you have to reclaim some of the levels that you saw in early to mid-March.
Base building.
Are we there? Have we seen
no,
it?
But is base building 3 months or is base building a year? I guess that's the heart of the matter.
I think it's longer than that. I think it's 6 months plus.
Right.
And it's not just the banks. The consumer finance names are weak. Look at Capital One or Discover. The boutique investment banks, Evercore, Moelis, Lazard, are all on their lows. the asset managers,
Right.
BlackRock, which should reflect the S&P, right? BlackRock is a top 3 holder
Sure.
of 99% of S&P stocks. It should look like the index. That's below the 200.
Right.
So there's something sick within these financials.
Right.
What that is, I think, will reveal itself over time. But to say that the financials are giving a
Right.
endorsement message here, I think is a bit of a stretch.
I got 8 ways to go here, folks. And for Dennis Gartman watching this morning, I've got to go there. He's going to go lower right to lower left to the upper right on gold. Gold sustains at 2,000. Nobody's really talking about it. I don't hear it in the zeitgeist right now. What is the technical construction of a bar of gold?
I think it's fantastic. We try to talk about it every day. And, gold's been a leader now for the better part of the last 6-7 months. It's the only time in recent history we can find where the S&P is more than 6 months off its low, but gold's up more. Gold's up about 20 over the last 6 months. Gold's up, S&P's up 15. This consolidation in gold prices the last few weeks has been so benign. Absolutely no technical damage done. Even as rates have pushed higher here again, the pause in gold, I think, looks orderly. Next move to us is higher.
How do you express gold? Is it through an ETF? Are you buying powder? Are you buying gold dust? What's the most efficient way?
Buying GLD. It's the closest play through paper we can get the physical.
Right.
I'd be skeptical of some of the gold stocks here, just given the weakness in the metal and mining complex broadly. But the physical, I think, is the best way to play.
Okay, I got some distribution here at 2,000. I'm going to go all Louise Yamada on here and say, what's your vertical count off of gold hovering at 2,000? Is your framework 2,200, or can you go even higher?
So targets, I think, are a very precise objective in a very imprecise business. My target's higher. If you want a number,
that's safe.
I can get you 2,350. I think that's going to prove to be conservative. I like the asymmetric qualities gold presents here. I think on one hand, it may protect us against the bad outcome, hard landing, a deep recession. But on the other hand, I think it also works in an environment where the Fed goes back to old habits and prints money. So I like the very asymmetric qualities gold presents. I don't think I need to get the macro right to get gold right here.
What's the dollar say? We started with Elsa Lingos this morning at RBC Capital Markets. I thought she was indeterministic about dollar trend as well. Do you detect a dollar trend now off BBDXY or DXY?
I mean, I think DXY, you have to remember, is mainly euro, right? So you're talking 60% euro. Yeah. On balance, I think dollar trend is down. It is a little bit more disparate than that.
Is it tradable?
Gun to my head, we're going to get meaningfully lower dollar over the next 12 and 24 months. Right here, I'm not convinced. When you look at dollar yen, you look at dollar Aussie over the last 24 hours, you can make the case for a mean reverting move here. Yeah. I think the overall trend in USD is down.
Jason emails in here from a cigar store in Midtown Manhattan and says, what's your single best buy? Do you have an individual stock that needs to be acquired this morning?
Yeah, I think when you look through healthcare here, there's some decent charts. We focused on Hologic this morning. And
you're the second person today on like Dow Component, United Healthcare. Is that trendable?
We're not there with the managed care names. UNH and Elevance are the two big players there. I think they're weaker charts, but look at the big farmers. Merck is a very good long-term picture. That would be at the top of our list here.
And what's great about this, folks, is you got Chris Verone as a technician talking up Merck, and I know that's one of, as a fundamentalist, Bill Smead and his fabulous Smead Value Fund, that's one of his top holdings as well. We got to say that for another time. Clinic here with Christopher Verone with Strategas. I'll get a 3, 2, 1. Strategas, a Baird company as well. You want to learn more about that? It's simple. On technical analysis, read the books and start there. What we're going to do is at 12:15, a conversation, Bloomberg Technology, with Uber's chief executive officer. They're going to lift up the conversation on what appeared to be bang-up earnings as well. Futures -7. Stay with us. This is Bloomberg.